Okay. Welcome, everybody. This is the CECL roundtable, as everyone knows here. We've got a full house. We're here in Norwalk. Just a couple of reminders before we get started. First of all, this is being audio cast. It will be recorded and archived, so you can replay it as many times as you like. We're going to do a couple basic housekeeping things before we get started. The usual mic test, and everyone who's been here before understands the rules. You depress the little push button, speak, and then depress it when you're not talking. So I'm going to ask everyone to go around and introduce themselves, name and affiliation. I'll start. Hal Schroeder, FASB.
Darian Williams, FASB staff.
Saul Martinez, UBS.
Sandy Peters, CFA Institute.
Gary Buser, FASB.
Barb Vantage, PCAOB.
Bob Storch, FDIC.
Sydney Menifee, OCC.
Allison Clark, NCUA.
Joanne Wakeham, Federal Reserve.
Laura Beth Butler, First Citizens National Bank.
Tim Zimmerman, Standard Bank.
Doug Wright, Mission Federal Credit Union.
Kevin Guckian, Ernst & Young.
Mike Spichala, M&T Bank.
Tim Golden, Capital One.
Jim Croker, FASB.
Brad Kimbrough, Regions Financial.
Cindy Powell, BB&T.
Russ Golden, FASB.
Chris Doritas, Moody's Analytics.
Fred Cannon, KBW.
Chip Curry, PwC.
Mike Tuvey, Bank of America.
Brett Dooley, JP Morgan Chase.
Marcia Hunt, FASB.
Dan Pelimaki, Citigroup.
Mario Mastrantoni, Wells Fargo.
Graham Dyer with Grant Thornton.
Doug Jepson, FASB.
Christine Bodison, FASB.
Sue Cosper, FASB.
Shandy Smith, FASB staff.
Damon Romano, FASB staff.
Jay Shaw, FASB staff.
Shane Ganek, FASB staff.
And Chris Kreiderman, FASB staff.
Thank you. A couple of the housekeeping items. Jay Shaw reminds me that if you want to ask questions or make comments, you do the standard put your name tent on edge, and he will keep track of who's come up. It's usually in order. However, if you've got a particularly important point that you want to make and you cannot wait, just put your two hands up in the air and Jay will try to track that and work you in as seamlessly as possible. Before turning it over to the staff, I want to express our deep appreciation for all of y'all making the effort to get here today. As I was talking to a few of you before, trains, planes, and automobiles, clearly, lots of different ways. Fortunately, the weather's been cooperative this time and everyone's gotten in safely. I also want to thank everyone that we've been talking to the last 2.5 years. You know, after we issue a standard, we go through a monitoring process just to see how things are going, making sure everyone understands what the standard says. And this is true of CECL, and it's been true of all the other standards, particularly the major standards. So I want to just express deep appreciation for the effort that you all put in. And when you talk to us, we know it takes time out of your all schedules, and it is not unnoticed on our part. I also want to take a moment to express particular appreciation to a few of the banks that have invited us in to do what I'm going to call a deep dive into their implementation efforts. They were deep enough that we had to sign non-disclosure agreements, so don't worry, guys, I will not be mentioning your names here today. We find all of these types of dialogue incredibly constructive and helpful, and it does have an impact on how we think about the standards, what we need to do going forward. I know Shane and I have done a lot of speaking last year or two. It modifies what we say and how we say it, so we're trying to really work on getting our points across. So please keep the constructive comments coming. In general terms, what we've heard, kind of 3 buckets. There have been significant improvements in several areas. We've talked in the past about improvements in data quality, estimation processes, internal controls, coordination. Those have been some pretty consistent themes throughout all of our discussions. Some other things that we've heard, and this one surprised me a little bit, but it was felt by several banks in particular that these improvements were necessary, and they would have happened even if we hadn't required CECL or the regulators required stress testing. They would have happened anyway. The only thing that CECL and the stress test have done is accelerated the process, the timing. And then finally, and this has come up more recently as we've done some of these more detailed discussions, and that we're going to come out today and talk about some of this a little bit more, you expect some of these improvements to continue, particularly as it relates to data and estimation processes. So that was very encouraging. I would say overall the takeaway has been it's a high quality implementation effort. We expect nothing less, but you guys really have exceeded expectations in many ways. So we've been very impressed. You haven't taken this as a compliance checklist type of approach. You've taken this seriously, and you're really working hard to implement this standard the way it was intended. So with those comments, I'm going to turn it over to Shane. Yeah. Good.
Thanks, Al. And I'd like to echo Hal's comments on the thanks. We do know that it takes time. We realize that there's a commitment to carve time out of your day to travel to be with us and also to participate. And so I'd also like to acknowledge those that have participated in our most recent outreach sessions leading up to this meeting and the ones that will participate after the meeting. It's not lost on us that this is earnings season and schedules are filled with your normal day jobs, so thank you. A couple of housekeeping items. We'll be covering 2 items today. The first will be a discussion of a proposal submitted to the FASB regarding presenting and recognizing expected credit losses on the income statement. And the second will cover whether gross write-offs and gross recoveries should be presented in the credit quality disclosures. This roundtable will be a bit different than maybe previous roundtables, either you've attended or watched online or watched from the audience, in that in previous roundtables, typically the staff tees up an issue, presents its research, its recommendations, and then we get input from those around the table on those recommendations. Today, for the first issue, we're actually going to have the members, representatives of the signers of the letter, tee up their proposal and kind of go through the proposal, and then we'll open it up to all the participants. So that is something a little bit different. For the second item, the staff will actually tee up that issue, the gross write-offs and gross recoveries. It's primarily going to be a recap of what we discussed in the TRG meeting, and then we'll open that up to all the participants. But before I turn it over to the representatives of the proposal that was submitted to us, on behalf of the CECL team, I'd like to make a couple of opening remarks. First, today's discussion regarding the proposal that was submitted to us would be one primarily about recognition and presentation of credit losses in the income statement, and not about the estimation of the CECL reserve itself. The proposal reads that it would, quote, retain the CECL methodology's intent of establishing an allowance for the lifetime of an asset on the balance sheet, but recognize the provision for credit losses in 3 parts. 1, for non-impaired financial assets, loss expectations within the first year would be recorded to provision for losses in the income statement, with 2, loss expectations beyond the first year recorded to accumulated other comprehensive income, or AOCI. And 3, for impaired financial assets, lifetime expected credit losses would be recognized entirely in earnings, close quote. The staff believes it's important to highlight this because the CECL standard was issued as a final in 2016, and entities should continue moving forward with their implementation efforts. Said differently, the proposal does not change the core tenets of the model. That is, estimating credit losses over the contractual term of the financial asset adjusted for prepayments. Secondly, the staff would like to provide insight into our process for those that may not be entirely familiar with how we develop accounting standards. Accounting Standards Update 2016-13, otherwise known as the CECL standard, began in October 2008, whereby the FASB and the IASB created the Financial Crisis Advisory Group, or FCAG, to deal with the reporting issues arising from the global financial crisis. FCAG considered how improvements in financial reporting could enhance investors' confidence in financial markets. In its report issued in July 28, 2009, FCAG identified delayed recognition of losses associated with loans and other financial instruments, and the complexity of multiple impairment approaches as primary weaknesses in accounting standards and application of those standards. FCAG recommended exploring alternatives to the incurred loss model that would use more forward-looking information, because the incurred loss model delays recognition of credit losses until it is probable a loss has been incurred. Similarly, the Financial Stability Forum, FSF, issued a report on the FSF Working Group Committee on Provisioning in March 2009 that recommended the FASB and International Accounting Standards Board should reconsider the incurred loss model by analyzing alternative approaches for recognizing and measuring loan losses that incorporate a broader range of available credit information. These recommendations resulted in the issuance of multiple due process documents: a 2010 exposure draft, a 2011 joint supplementary document, sometimes referred to as the Good Book and Bad Book proposal, and a 2012 exposure draft. The FASB also established a Transition Resource Group, or TRG. The FASB spent several years developing the standard to ensure its operability, utility, and transparency of information to investors and other users in a cost-beneficial way. So let me just cover a few statistics to put this into perspective. For the 2010 exposure draft, the FASB received, read, and analyzed over 2,800 comment letters, conducted 8 field visits with banking institutions of various sizes, non-financial entities, and an insurance company, received and analyzed feedback from 120 investors and other users of financial statements, and held 5 public roundtable meetings with more than 65 participants, including users, preparers, regulators, auditors, and others representing various perspectives. The consistent messages we heard as a result of those activities that are relevant for today's discussion were: respondents agreed with recording the entire credit loss in the period estimated. Superseding the probable threshold for recognizing credit losses was widely supported. Stakeholders asserted that the 2010 proposed update retained 3 different impairment models, that is, one for pools, one for individual assets, and one for purchased assets, which seemed counter to the recommendations by the FCAG. Stakeholders expressed concern about the requirement to assume the economic conditions would remain unchanged at the reporting date, and the primary issue was delayed recognition of impairment losses in net income. The FASB used the feedback heard to develop with the IASB the 2011 joint supplementary document. As part of the supplementary document proposal, the FASB received, read, and analyzed more than 200 comment letters, conducted outreach with preparers, regulators, auditors, users, and other interested parties. This effort amounted to meeting with more than 1,000 stakeholders representing more than 100 different organizations. The feedback that the FASB heard related to the supplementary document, or as I mentioned, the Good Book and Bad Book model, was leveraged to further develop an additional multiple measurement objective model called the 3-bucket model. As a result of those efforts, the consistent messages we heard that are relevant for today's conversation were: the most significant operability concerns related to the use of 2 different measurement objectives. That is, a portion of total expected losses for some assets and a full measurement approach for assets that have exhibited significant deterioration since origination or acquisition. Concern about ambiguity of the criteria for determining which measurement objective to utilize. Concern about the potential for earnings management relating to the timing of the transfers between measurement objectives. Concern about potential cliff effects of moving from an approach that measures a portion of total expected losses for some assets to a full measurement approach, and vice versa. The 3-bucket model would result in inconsistent application and would not provide users with comparable or transparent results. And users expressed concern about interpreting any model that utilizes 2 different measurement objectives to arrive at the allowance for credit losses on the balance sheet. The FASB once again pivoted and revisited previous tentative decisions on the impairment project, primarily relating to the use of 2 different measurement objectives. In doing so, the board developed the current expected credit loss, or CECL model, for exposure in 2012. For that exposure, we received, read, and analyzed more than 360 comment letters, obtained feedback from more than 70 analysts and investors, conducted 17 field visits with preparers, including multinational and domestic, financial and non-financial, and public and private institutions. And we held various roundtables with preparers, investors, and regulators to discuss the 2012 exposure draft. As a result of this effort, we heard the following that is relative for today's discussion. Investors and other users strongly preferred a model that records the full amount of expected credit losses. Investors stated that they saw no point in recognizing different amounts of expected credit losses on the basis of whether default events are expected within a specific time frame. Investors also disagreed with the idea of using any other type of trigger for determining the amount of expected credit losses recognized, which they asserted would add another layer of subjectivity into an already subjective estimate. So in summary, that adds up to approximately 3,300 plus comment letters, 25 fieldwork meetings, 85 plus meetings and workshops, 10 plus roundtables with more than 100 representatives, and meetings with over 200 users of financial statements prior to the issuance of the final standard. Many of you around the table participated extensively in this process. So clearly, I think everyone would agree that we have met with a number of different stakeholders as part of this process. And I would add the listening does not stop with the issuance of a standard. As mentioned, the FASB has established a Transition Resource Group, or TRG, to deal with the post-issuance issues as we continue to listen to our constituents. We held 2 TRG meetings before the standard was issued to inform the board on operational concerns in advance of issuing a final document. As a result of these meetings, we made additional changes to the standard to clarify the board's intent and enhance its operationality. And we have held 3 TRG meetings post-issuance to discuss implementation issues that have arisen and to educate stakeholders broadly. The most recent TRG meetings have resulted in some targeted amendments to the standard to provide clarity and to address operational concerns on a wide array of issues, including but not limited to clarifying effective date issues for non-PBEs, which has been finalized as a standard, treatment of accrued interest, transfers of financial assets, and treatment of recoveries, among others. Also, it should be noted that in the run-up to this meeting, we conducted approximately 30 to 35 hours of outreach calls with 25-plus institutions of various sizes, both financial and non-financial, some of which are sitting around this table today, to understand their views on the proposal. That, of course, brings us to today, where we are again here to listen and react to our stakeholders. We have gathered institutions of various sizes, both large and small, to understand the tenets of the proposal and how it might impact financial institutions beyond those that submitted the proposal, practitioners to understand auditability issues, and users to understand the decision usefulness of the information provided. The information that we learn here today will be combined with additional information the staff has received as part of our outreach process and our own research. The staff will provide a full analysis to the board late in Q1 so that they can determine any next steps at that time. To be clear, we are not asking for an up or down vote on the proposal, rather to become more informed as we analyze this proposal in anticipation for a discussion with the board toward the end of the first quarter. With that, I'll open it up to the group for any questions or comments on my remarks, and I thank you for your attention.
No comments? Okay. So I guess we'll turn it over to the signers to kind of do their opening discussion and their opening tee-up.
Thank you, Shane, for that robust tee-up to the proposal. Thank you for the opportunity to participate in today's roundtable discussion. My name is Tim Golden, and I'm the Controller and Principal Accounting Officer at Capital One Financial Corporation. Capital One was one of 20 financial institutions that participated in the development of the proposed CECL amendment. We believe our proposal is worthy of consideration by the FASB, and I'm grateful for the opportunity today to discuss that at this roundtable. We recognize the importance of FASB's role as the independent financial accounting standard setting body in the United States. FASB's mission to promote financial reporting standards that provide useful information to investors and other stakeholders is critically important, and our U.S. capital markets have benefited from their independence. FASB's decision to hold today's public roundtable is a testament to its transparent and inclusive process. The amount of outreach and diligence informing the current expected credit loss standard by the FASB is commendable. The FASB, along with the many stakeholders that have participated in this process, have worked in good faith to develop a standard that address many of the perceived shortcomings of today's incurred loss model. This process has lasted many years, and numerous other models, including models that have some similarities to the proposed amendment, have been discussed. However, we believe there are meaningful differences between our proposal and other models previously considered by the FASB. We also believe that it is important to highlight that our proposal has been greatly informed by information that was not available earlier in the standard setting process, and that this information has highlighted certain significant risks to the macroeconomy that we believe must be considered by the FASB to avoid unintended consequences. We agree with those who say that CECL is the most consequential accounting change to ever impact banks and financial institutions. That is why we are here, prior to its implementation, to ensure we've had the opportunity to consider all the different viewpoints on CECL's impacts, share what we've learned, and ensure that the CECL standard strikes the right balance. A lot has changed since the financial crisis and the after effects when CECL was initially developed, and banks have learned a lot from their continued investments in modeling, stress testing, capital management, and CECL readiness work. What hasn't changed, however, is the ability to predict turns in the credit cycle, when they are going to occur, how bad they are going to be, and how long they will last. When we consider industry research and our own internal backtesting of our economic forecasting, the results are clear. The further out a forecast goes, the less reliable it becomes. Most importantly, this lack of perfect foresight is particularly acute in times of stress. While we support the FASB's decision to incorporate the use of forward-looking information into credit loss estimation process, the use of such forward-looking information also represents a challenge as a result of the difficulties associated with forecasting. Even though CECL is a principles-based standard that provides a tremendous amount of flexibility, we believe the likelihood of forecast imprecision as we enter economic downturns, combined with the disconnect in the loan's earnings cycle, will create a flaw in CECL's lifetime loss estimations. We are concerned that these flaws could have significant unintended consequences that are incongruent with CECL's initial objective. These consequences most significantly include an amplification of procyclicality and not a mitigation of procyclicality as originally intended. We also believe that front-loading lifetime credit losses will distort the economics of lending, punish growth, and limit the availability of credit when the U.S. economy needs it most. Consumers, small businesses, and those with less than perfect credit will likely be impacted the most in these stressed environments. Further, we believe the standard's flexible principles will create a lack of comparability driven by differences in views around economic outlooks, through the cycle mean reversion techniques, and differences in growth patterns. The collective consequences of these results are likely to be significant.
Good morning. My name is Cindy Powell, and I'm the Corporate Controller of BB&T. We also participated in the development of the proposal. We are requesting that the FASB revisit the current CECL standard and consider amendments consistent with the approach outlined in our white paper. Our proposal attempts to solve for or mitigate some of the issues that were discussed by Tim. Our proposal was written as a framework that leverages the beneficial aspects of CECL, while at the same time addressing our most significant concerns. One thing I'd like to point out is that our proposal wasn't meant to address all of the implementation details that will require further development. We believe these items could be identified in FASB's normal, robust process and through the industry comment process. As previously stated, we are concerned that CECL could impact the availability and pricing of credit and create disincentives for banks to lend. We are aware of requests for the completion of a quantitative impact study by a number of different constituents, but believe that these types of studies are more appropriately coordinated by other stakeholders and not the role of the FASB. Based on the potential for significant unintended consequences that CECL may have on lending and the broader U.S. economy, we continue to believe that it would be prudent for such a study to be performed. Notwithstanding our support for the completion of a QIS, we believe that our proposed amendment to CECL provides a framework that keeps the most significant aspect of the CECL standard, that is, expected lifetime credit losses, which would continue to be reserved for on the balance sheet and reported to investors, while at the same time addressing our regional banks' most significant concerns from a financial accounting perspective.
Good morning. My name is Mike Spichala, and I'm the controller of M&T Bank Corporation, and we also participated in the development of the proposal. This proposal would bifurcate the current expected loss estimates into two components to improve income statement recognition. Net losses expected to be realized in the next 12 months on impaired assets, plus full expected lifetime losses of financial assets specifically identified as impaired, would be recorded in the provision for credit losses. Expected credit losses on non-impaired assets expected to be realized outside of the 12 months would be recorded in other comprehensive income. The total of these two amounts would aggregate to the total current expected credit losses recorded as a valuation reserve on the balance sheet. The benefits of this proposal would include the following. First, It maintains the FASB's objective of utilizing forward-looking assumptions in determining the appropriate allowance, as well as maintaining the lifetime loss principle on the balance sheet. The proposal would also recognize the importance of the income statement to investors and remove the distortion and volatility of booking lifetime losses prior to recording any revenues. In other words, we believe that the proposal would more appropriately reflect the economics of lending. Further, while the proposal doesn't eliminate the potential procyclical impacts driven by forecast imprecision, it does mitigate these impacts by recognizing more uncertain losses in other comprehensive income. We believe this methodology would enhance comparability among banks and is consistent with the existing OCI frameworks that are utilized in other standards to recognize the timing of gains and losses. The proposal would also provide additional meaningful decision-useful information to investors and other users of financial statements by providing each company's estimate of current period losses in addition to lifetime losses. Finally, we believe this proposal would provide bank regulators additional decision-useful information in determining the appropriate bank regulatory capital regime that would coexist with the CECL standard.
Good morning. My name is Brad Kimbrough. I'm the Controller and Chief Accounting Officer for Regions Financial Corporation. We also participated in the development of the proposal. While the proposal does not require complex tracking like IFRS 9, we acknowledge that the proposal will require additional model precision. However, we believe the benefits associated with our proposal far outweigh any potential costs associated with these requirements, as we believe that a bifurcated CECL reserve provides more transparent information to investors, banking regulators, and other users of the financial statements. While we've had a limited amount of time to evaluate the modeling requirements necessary to implement the proposed amendment to the standard, none of the institutions that participated in the development of the proposal identified obstacles that could not be overcome. We recognize there will be additional time needed to identify specific implementation issues, such as the bifurcation of qualitative reserves, and additional implementation guidance may be required. We do not view any of these issues as showstoppers. We also recognize that smaller financial institutions may have concerns related to the additional modeling requirements driven by our proposal. However, to the extent that less complex approaches have been developed to facilitate the estimation of credit losses in accordance with the requirements of CECL, we believe that similar approaches could be developed to bifurcate losses in a manner consistent with our proposal. You might ask, how quickly could your proposal be incorporated into your CECL estimation process? While we believe that most of the organizations in our industry would make every effort to incorporate the necessary changes in time for a 1/1/20 implementation date, we have to acknowledge there are risks associated with such a timeline. In order to ensure that appropriate internal controls over financial reporting, each organization would need to employ prudent risk management procedures that include model validation, incorporation of the new requirements into the company's control environment, and sufficient testing through parallel run processes. As part of the consideration of the proposal, there should be serious consideration to the time it will take to issue a revised standard and then implement these processes. We appreciate the opportunity to present this proposal to the group, and we look forward to your questions as we discuss further. Thank you.
Thank you. So I guess just first question for the group. Brad, you mentioned implementation and kind of, some of the risks with meeting the 1/1/20 deadline. I guess for the others in the room, maybe if you can talk about where you are with implementation of the CECL standard and how the proposal would interact with your project timelines, if there was anything you would have to kind of redo, or is there any additional work that may be incurred with the proposal, and what are some of your initial thoughts on implementing and being ready for 1/1/20 with regards to the proposal? So. I'll call on you if I don't see 10 cards go up. Seriously, I will call on you. Okay. All right. So I guess, Dan, do you want to go first? Thank you.
Yeah, I guess, what I would say overall, certainly from the city perspective, we have every expectation to be prepared and ready to go 1/1/2020 relative to the CECL standard as it stands today. And overall, I would say that city is very supportive as FASB being an independent standard setter. We think the process that you follow today is the best it can be. It's results in standards that will produce, we believe, the highest quality financial statements. We think you've done a great job, Shane, as you went through and outlined all of the work that you've done over the last, I've lost count the number of years now, but you have really responded, in our view, to all of the commentary. You've been very thoughtful, so we don't think it's necessarily fair to the process at this very late stage to re-debate and relitigate a lot of the issues that I think have been given significant consideration by the board over a very lengthy period of time. So I don't think that that's good overall necessarily from a process standpoint. And so at this stage, our preference from a city perspective is to move forward with CECL implementation. We think FASB, through its process, has decided that this is the best model from a GAAP financial reporting perspective. We think that really most of the debate today centers around the treatment from a regulatory capital standpoint. And that's really where the focus should be, is what is going to be the permanent treatment relative to CECL from a capital standpoint. And so appreciating that really, the regulators need to take the lead in that, but I think as an industry, we need probably to be providing a lot more quantitative information as well so that they can make informed decisions. And I appreciate that that's a challenge, as a lot of us within the industry are completing model development. We don't know the exact results right now from a base case perspective, from a stress scenario going into recessions and so forth. But that's really where we think the focus needs to be at this point in time. We can get into more of the discussions certainly this morning on incrementally what is this proposed model, what additional challenges will it put out there from an implementation standpoint. And so that's we have questions surrounding what is meant by 12 months of expected loss, for example, and there's some discussion of that within the paper, and I know maybe that's trying to be vetted out a little bit more further, and depending on the size or sophistication of the institution, there might be different approaches to going at that. Is it the 12 months of historical losses? Are we trying to just get to a number that equates to what we expect to charge off over the upcoming 12 months? Or is it a model closer to IFRS 9 where we're trying to look at what loans will become impaired over the next 12 months and make sure we have lifetime losses for those? So there's a whole number of different models that are there, and then you have to think about, all right, if I'm going to, for this, the amounts that are going to hit cost of credit and go to the income statement, I need to overlay that with my expectations about what the next 12 months economy is going to be like, the macroeconomic factors. And so taking with what we've built today that's focused on CECL and just taking the first 12 months of that and factoring that in as well, so there'll have to be a process that surrounds that. And so it does occur to us just reading the paper that if we go through and apply this methodology, that likely it would result in lower loan loss reserves hitting P&L than what we do today under the incurred loss model. That seems to be true from our perspective, and so that doesn't necessarily make sense to us as well. But I guess, those are just some opening thoughts since I was forced to volunteer to speak first.
Well, thank you for taking the first bullet. I don't see other 10 cards up, so I'm going to continue calling on people. So Brett Dooley, do you want to go?
Yeah,
To focus on your question about the proposal and where we are in our own implementation and what this means to that. Obviously, it's been a couple of years now since the standard was issued. We spent a lot of time in that first year on accounting interpretations and working through the TRG process as well as our own internal process to, think about those implementation questions that were really accounting focused. Over the last year, we've spent a lot of time in model development, then working through changes to our models and enhancements to our loss forecasting models to be ready for implementation in 2020. And then, we're looking forward to this next year as really a year of parallel runs, which we feel is a really important and critical time period to challenge the modeling we've done, make sure we understand how it's going to operate, how are we going to communicate this to investors, et cetera. So I think that at this point to add in what we view as not an insignificant addition to the model would put significant pressure on our ability to implement, on the original time frame. It would require us to go into all of that modeling that we've done and do enhanced bifurcation and challenge that. I think a lot of times where we've had tensions as a preparer community with accounting models, it's where we have a sharp distinction between an accounting treatment that's not based on a fundamental economic difference. And so I do see some concerns with having kind of a sharp and somewhat artificial 12-month cutoff. To Dan's point, unclear exactly what that cutoff is, but that cutoff between what hits earnings and what hits OCI, because that is an important distinction. And I think that the judgments around that distinction will become even more important and will require even more work to make sure we have that right if that distinction is made in the financial statements. Beyond the specific modeling done, obviously an important part of our allowance process is thinking about qualitative adjustments that need to be made to those models to address shortcomings, uncertainties, et cetera. The framework then for bifurcating those sort of qualitative judgments, I think, becomes even more challenging to differentiate those judgments that affect your 12-month estimate versus the judgments that require a longer-term estimate. I think that would take some time to think through how to do that in a rigorous and supportable way, even once you have the modeling complete. I agree with the comments Dan made around the importance of capital, and as one of our concerns, frankly, with CECL has been the capital treatment, both as a BAU ongoing permanent capital relief, as well as dealing with the implications of CCAR. And so we've said consistently we do think it would be useful and productive to have more dialogue and more thinking around that regulatory capital impact of that. It's not clear to us that this proposal is the best or most efficient way to address those fundamental capital issues. If we were to take some time to think through those capital issues and come up with different proposals, I'm not sure that the one on the table is the one that would be our preferred outcome or our preferred approach.
Thank you, Mario, for putting up your 10 card. You can go ahead.
You were going to call me next anyway.
I'm going to call on Michael next, so go ahead.
I'll try not to be redundant. As it relates to our implementation, I would say we are on track for implementation on a timely basis. We're in the process of starting our parallel testing, a really important part of the phase of our implementation. If the alternative proposal were to be adopted, I don't think it would be possible to implement timely. I think there'd be too much recalibration of our current process, development of ways to produce the new disclosure information. There'd be a lot more work to do. So just understanding how the process works and getting it deliberated and getting it issued, we're talking probably sometime in the third quarter before you have some guidance in 3 months to implement. So I don't see how that can work. Conceptually, I think we also have similar concerns with the alternative proposal. It seems to be trying to solve for a capital problem, and that solution may work for many institutions, but it doesn't work for all institutions, particularly the large banks at this table. So putting losses in other comprehensive income doesn't impact our regulatory capital at all. It provides no relief for us. Having said that, we do have some sympathy for some of the concerns that have been raised by the banking group. While we don't support this alternative proposal, we certainly would support taking time to do some more study on the economic impacts of the standard. Our institution, our organization does believe the standard will react poorly under stress, is concerned about how the impacts of the standard when you're coming out of a recession, and just thinks more time could be taken to understand the impacts on capital and stress testing and lending in general.
Thank you, Mario. Go ahead. Yeah, go ahead, Brett.
Yeah, I'd just like to point out each of these individuals mentioned the impacts on capital. We believe that the impacts on the income statement are really what's important. That's what's driving our proposal. If you think about the economics of lending, having the 1 year worth of losses in the income statement relative to a full lifetime period of losses, we think is important. We think that would be useful information for investors. We think that would limit volatility. We think there are a lot of benefits to that. So just wanted to point out that our key point is related to the way the income statement presentation would be laid out under the proposal.
Thank you. Michael?
Yeah, I just second the comments from Brett, Dan, and Mario. It's difficult to see how you could make the changes during a critical time period of implementation in this year. Work through implementation issues, have public debate, TRG meetings, then feed that to the modelers, feed it to the model validators, recalibrate forecasts, make changes to systems to actually identify the information that you would need to disclose for the 12 months. So, I think to think, at least for larger institutions, that you could do this for 1/1/2020 is just not, I think, consistent with reality of the process. And I think we've seen that in the process that the FASB has conducted. Very thorough, very deliberate. It's taken time, and I think that just goes to show the strength of due diligence and the forums that get created to discuss all of the many issues that have come out over this last several year period as the FASB has developed the CECL model and gotten it issued and gone through implementation. So, I think this is the right path. It's difficult to understand how this model would actually change things. I think personally that analysts would just look to the entire lifetime credit that's sitting in OCI and say, this is it, and wouldn't really distinguish between 12 months and over 12 months. So, it's not necessarily clear how this really furthers the ball down the field, in my opinion.
Go ahead, Russ.
So Dan Palamaki made a good point that I wanted to get the feedback from those that signed it. Dan observed that, at least at his financial institutions, and I would ask first the larger financial institutions, this is true at your organizations, that if we were to truncate the P&L at 1 year, that would cause, in essence, an increase to retained earnings, implying you currently go out more than 1 year, right? Is that the other? So with respect to the signers, is that true at your banks? Do you currently go out 1 year, and would retained earnings decrease if we did your proposal, or do you currently just look out no more than 1 year?
Go ahead, Tim.
Well, I think it depends on the makeup of the portfolio, obviously, and I think it's important to also acknowledge the proposal isn't just 12 months. It's 12 months for those unimpaired assets, and for those identified as impaired, it's lifetime. So, when we talk about this being 12 months and that's going to result in your provision through the income statement being less, I just think that's it's a broad statement that's not necessarily true for many. I don't think it would be true for us, particularly given my company is consumer focused, so the vast majority of our reserves currently are 12 months through their loss emergence period. We have a big commercial book. Obviously, that goes beyond that. So there, it depends on the book, Russ. I do think details matter, and just making a blatant statement might not necessarily be the best way to follow there.
So I know I had asked you to consider, why not current GAAP on the income statement? If your primary concern, as Brad talks about, this is not about regulatory capital, this is about the income statement, why 1 year, why truncating it 1 year and not the current GAAP?
I think when the proposal group debated and when BB&T met with Hal, and we talked about a lot of different models, whether we continue to use incurred loss, do we do reasonable and supportable? There's a whole bunch of different reasonable methodologies for employing a bifurcation model. I think what we were trying to focus on, in incurred loss for us, one of the complex parts of that is then you have two models, one utilizing forward-looking assumptions and one not. And so it's not that it couldn't be done, but then you have two separate and distinct allowance processes that you're starting to run. And so we were looking at the aspects of operational complexity and leveraging the current CECL decision around forward-looking assumptions.
I'm going to let Mario jump in. Your 10 cards. Oh, sorry. That's your fault. All right.
So Jay, maybe we can hear from, Doug, Tim, Laura, from a smaller institution perspective, where you're at in your implementation, how this would impact that, so on.
Sure. I think from a smaller institution perspective, my perspective is that the challenges for CECL continue to be primarily operational in figuring out how to we scale CECL down to small institutions, and that I know FASB has heard, as well as the regulators have heard, that that's an ongoing issue for smaller institutions. So to the extent that this proposal in particular impacts operability, a lot of us don't have a 1/1/20 implementation date, although some of us do. That is going to challenge the 1/1/20 implementation people similar to the large banks. I mean, if they've got a lot more resources to be able to manage a 1/1/20 implementation date, the smaller institutions who have that date are going to be challenged from an operability standpoint with this change. So there's no doubt about it. Even the institutions that are non-public business entities who are a little later implementation date are struggling with the basic operational implementation of CECL. So adding to the complexity by implementing this proposal would create more challenges and I think more issues from an operability standpoint. Having said that, I think the primary trade-off in that respect is probably getting back to what's already been represented, which is the regulatory capital treatment. If this provides a more favorable regulatory capital treatment, I think some institutions, I can't represent all, but certainly some institutions would probably view that as a favorable outcome depending on what your capital and proposed capital position is. And so I think in many respects from a smaller institution perspective, it really becomes a trade-off between operability and regulatory capital. And I understand, from a theoretical perspective, there are probably reasonable arguments either way, and I understand, the income statement impacts and the discussion around that. But I really think for a lot of institutions, particularly non-public business entity institutions, it becomes an operability regulatory capital trade-off, and we don't know absolutely or exactly specifically where the regulators are standing in this respect and how they would treat that. So it's not an assured thing from a regulatory capital perspective. So that's something I think we'd want to explore further. So I think that's kind of my perspective on it. But
I'm going to let Christine jump in, and then I'll go right back to you, Tim.
I just wanted to follow up on your comment about the regulatory capital benefits. So if there was no regulatory capital benefit to bifurcating the provision, would you still be in favor of going through the cost of changing your systems to implement? Do you believe that the information regarding the 12-month component is useful information to users regardless of regulatory capital concerns?
I think, from a...
Doug, could you get a little closer to the mic?
Certainly.
And a couple of you, we've just got a little note here that some people cannot be heard as well as others.
Okay. I think it becomes to answer your question directly, I think it becomes more challenging to identify the benefits for smaller institutions who are already very challenged with operations to add an additional layer of complexity without the regulatory capital treatment, honestly. I listen to the arguments that, the larger banks are talking about kind of their operational concerns and so on, and apply that. I say, we're struggling with the estimates and so on, and then to bifurcate over a 12-month or a longer period makes it even more challenging. And I'm not sure and this is my personal perspective, I'm not sure it benefits the users that much to have that bifurcation between 12 months and onward. I tend to agree with the assertion made, I think it was by Michael or someone, that from a user perspective, I would probably take a look at the combination of the 12-month and income statement and the OCI and combine those all together. And from a user perspective, I'd probably be asking for a lot more quantitative information so I can basically plug it all into my modeling and figure out from a modeling perspective what I really believe that, total expected credit loss standpoint is, and compare that to what management is indicating. But that's my own perspective from a user perspective.
I'm going to let Tim go, then I'll come to you, Cindy.
Actually, as Doug kept talking, I could check off what I was going to say pretty much. So, but it is interesting that from a smaller institution standpoint, some of the things that Dan outlined in his comments, I think I actually agree with, because this idea of a hard cutoff after 12 months is going to introduce one more level of issues that we have to deal with. And what Doug is saying is absolutely true for community banks. In fact, most community banks at this point haven't yet implemented CECL. They're still trying to figure out how they're going to approach this, and actually selecting methods. That they're down to the short strokes on that kind of thing, but the operational things are more of a challenge. And then also the idea of where will we end up as far as regulatory capital goes. That's a big concern for everyone. And I am actually think that when everything's distilled down here, it seems to me that capital seems to be the bigger concern, even though I'm hearing that it's the income statement. But I really think that's what this is sort of coming down to. And we certainly don't want to add one more component that we have to address at this point, because we think we have our hands full, particularly the smaller institutions. Even though there's a longer period of time for implementation, we have limited resources, and we have a couple people doing a whole lot of different things, and they're challenged to be able to keep up with and be able to implement this. And actually, backing up to the 100,000 foot level, the smaller institutions, we actually felt that the original model that we were using was a pretty good model, and we've gone for a long period of time using that model and getting, we thought, pretty good results from that. And being able to add just a small piece to allow forward-looking judgments also into this would have probably been sufficient for us. But be that as it may, at this point, we're saying don't add one more piece of work for us, because we have plenty to do.
I'm just going to let Laura go, just so she can jump in. Sorry.
Just to add, in terms of, I think it's really important for FASB to understand that from what I see, that the gap is widening. So the larger the bank, the more sophisticated the systems, the more CECL ready, and the further behind I truly believe that community banks are. I will say from my perspective, I'm educated about CECL. I've been involved in CECL. I've been looking at how to make it workable for my institution, probably more so than some of my peers, but I am not happy with where I am in terms of the transition. And it's because of things like the operational hurdles. And so I appreciate the time and the effort that's been put into trying to find a perfect model that is flexible and is great for big banks and small banks. And I get all that. And there's some things about it conceptually that I think
make a lot of sense. But when you start to apply those, whether it's, I think data, number one, is still a huge issue. Our cores are behind. Even some of the CECL solutions, I don't think are really where they need to be. I think we as community bankers understand big data analytics, but that's not what we're used to. We operate based on relationships. If you're in a large bank, they don't know their customers. They don't know their portfolios, and how could they given the size of that? So they've been relying on data for many, many years. That's not the case with the smaller institutions. So when you look at and you think about, and there's some parts about the proposal that I do actually like in terms of dividing it. I think there is a focus. I think there is an emphasis from a user perspective on what your next 12 months performance is expected to be. However, I do have serious concerns about the auditability of that because of the increased scrutiny over audit standards. And again, kind of to Brett's point about how do you make that judgment about over 12 months or under 12 months, and how do you have that in a format that is auditable and cost efficient, right? I mean, you think about that at a small bank's perspective and the resources that we have. And so while we're making strides, I think we do have very strong concerns. I think now that it seems kind of contrary out of the gate to think about doing a quantitative impact study when you've been looking at CECL for years. But I think the data that you have available and some of the things that are working and some of the things that are not working in our implementation, I think now it might be more important than ever, specifically because of the gap that you're seeing in even those of us who are spending time and effort to implement CECL as it's intended and still having hurdles and still concerned about the negative impact on our ability to lend, our pricing, the products that are offered. I think the timing of that quantitative impact study might be more important than ever.
And now, Cindy, who's been waiting patiently.
So just trying to get back to Christine, maybe a couple of questions that you had asked as it relates to the bifurcated approach. I think we would still say that the primary benefits of that approach are going to be it's a better reflection from an economics of lending. And so what I mean by that is CECL would require us to recognize lifetime losses up front, obviously when we receive the income over an extended period of time. The change in the timing of the recognition of those losses will in fact lead to a change in the economics of the transaction itself. It works the same way in my personal household. If you change the timing of my income or you change the timing of my expenses, it will in fact change the timing of the economic transactions that I enter into. So that's what we mean by that. The other benefit that I think that you're going to see with the bifurcated approach is the comparability. Because right now you've got different institutions that have different modeling techniques, different assumptions, whether it's about macroeconomic conditions or various other items, and we lack comparability. To put some finite period on the piece that's going to run through the income statement, we believe is going to give greater transparency and achieve more comparability between the institutions. And then lastly, I would say from an investor perspective, we tend to get most of our questions that are dealing in the 12-month forward time frame. Rarely are we asked about how things are going to, what will happen, years from now. It's more of what do you foresee on the horizon within the next 12 months or year.
Thank you. So I guess just, I don't know, one quick. Okay.
Cindy, I liked your household analogy. But I think when you were talking about your household, you were thinking cash, right? And are you suggesting that the accounting is going to change your cash flows?
No, it was not meant to suggest that the accounting was going to change cash flows. Again, I think it's more of you're going to be requiring institutions to recognize all of those losses up front. That's going to have an immediate impact as to how banks think about the lending. They will be immediately, it will have an immediate impact to earnings. It will make banks unprofitable to make that next loan. And that's something that banks are going to need to consider as we go forward into implementation, is what happens when we make the next loan.
Okay, but it doesn't change the cash flows. It just changes the reflection of that in the income statement. Yes. Right.
It seems like your comments are emphasizing the importance of the headline number, the number that they'd be reporting regarding this quarter or this year. And it seems like conversations that we've had with investors have suggested that, yes, it is a big shift to report volume, mix, and credit deterioration in a reserve relative to what's reported today. But it's based on our conversation, it seemed like they will be able to, with adequate and robust disclosures, be able to piece apart what's happening to understand that part of it is volume and mix and part of it is credit deterioration. Are you not finding that in the conversations that you're having with investors? And then I appreciate to hear from the larger banks, is there a difference in what you're hearing in terms of the ability to change, how the information has traditionally been provided and how it would be provided under CECL?
So maybe I'll take that one. I mean, one thing to highlight here is this is giving more information to investors, not less information. And so certainly when we talk in my bank to investors, there's a perspective, to Cindy's point, on a certain time horizon in their focus. We hear a lot of concern about how are we even going to model this in the future? How are we going to be able to evaluate you as a bank? How are we going to evaluate the segment, right? Given all the complexities and the like. The other part of this that I just don't want to lose sight of is what we're trying to solve for is procyclicality. And that was the whole driving force behind, the development of the standard too little too late being less procyclical. And if our modeling and other modeling shows that with lack of perfect foresight or even good foresight beyond a year, and as we step into recessions, what that means from a procyclicality standpoint, and the secondary impacts that then results into our income statement stability forecasts and the like, the downstream impacts to our ability to lend in those moments are, I just don't want to lose that particular piece when we say this is a method that we're focused on capital. This isn't on capital. This is real. There's an element of that. You can't disentangle earnings from capital. It's a part of it. We acknowledge it. But one of the biggest parts of what we're trying to mitigate here is the pro-cyclical points as the economy turns.
So Russ, you had something?
Yeah, I just wanted to explore a little bit about providing more information to users, because I agree with you. I think that the split does provide more information to users. I'm just wondering, I would be interested in thoughts around the table as to whether presentation is the best mechanism to provide that additional information. I mean, it seems that if we really want to provide additional information about bands, next 12 months, 24 months, 36 months, I mean, it could go on and on. Disclosure might be a better tool to provide that, and you could do all sorts of different cuts. You could do good book, bad book, you could do a time cut, you could do reasonable and supportable, and what's beyond that. So I just question why presentation, taking the regulatory capital piece out, if it's just about providing better information to users, what the thoughts are about presentation versus disclosure.
Russ, go ahead, Brett.
I appreciate your observation, Christine. I think that, in my view, using presentation to convey that probably isn't the most efficient or effective way. I think we had a lot of discussions during the development of CECL around the increasing uncertainty you have of an economic forecast the further you go out. This is not a new discussion. We talked a lot about it. I think we talked even years ago about how best to convey that increasing uncertainty, whether it was through formal disclosures at the time. And certainly our view then and continues now is that depending on the models you're using and the portfolio you're talking about, the way you'll talk about and convey the amount of uncertainty in your estimate is going to differ. And it's going to differ, I think, a lot institution by institution, and some of this is going to be new to us. And so I thought that there was a real benefit toward not being proscriptive in how we do that. And I think using presentation is very, very prescriptive. I think there's a benefit to not being prescriptive and let the market sort out how we can best do that. And I think we'll know better when we're a few years into this, how institutions are talking about uncertainty, how investors are asking questions about that measurement uncertainty. And it's not apparent to me at all when we're talking about uncertainty that, you know, the dividing line between losses that are going to be realized in month 13 or 14 are really any materially less certain or forecastable than in month 12. And so I think, again, that sharp line of bifurcating, you know, some losses from others just based on the time horizon is dangerous, and I think it gives actually kind of a skewed view of the certainty you have in those estimates around that time, around that margin.
Go ahead, Rob.
I wanted to get users involved, and they're raising their
Yeah,
hands, so
yeah,
I'll
so
defer to them.
that's exactly what we were going to go to. You know, we mentioned you know, a few things about users and providing more information. I guess maybe the first question, part of, you know, your comments, if you could just comment on, you know, one, I believe it was Mike that said, you know, the number sitting in OCI, they know what it is. Does that impact the calculus here, in addition to whatever you're going to say?
So I'm a sell-side analyst, and I actually cover a number of your stocks. But before I ask my questions, I do have to say one thing. The views I express here are based on my views as a research analyst and don't necessarily reflect my employer, UBS's views. In addition, my comments will be consistent with my views as a published analyst. So getting that out of the way. I'm curious, look, I think that segregating reserves in provision is helpful for the investment community. I think it helps. The proposal 12 months does help with comparability issues, helps with, you know, volatility, which, you know, the investment community is concerned about. I guess my question, though, is the way it's constructed, do you worry that it, in the process of doing that, creates other comparability issues and maybe makes the analysis more complicated? The earlier point, I think by Dan about how you measure 12 months losses, maybe, you know, is still unaddressed. But kind of thinking it through, what you know, for example, if I have a modeling adjustment on my back book and I true up reserves, but it doesn't impact my expected losses over the next 12 months by nearly as much, or if I reduce reserves because I adjust my modeling assumptions, but my 12 months expected loss expectations go up, it's going to be difficult as an analyst and for investors to kind of deal with a lot of and understand what's really going on. I wouldn't know how to deal with that. So by you're sort of separating out, okay, my lifetime reserves, you still have the comparability issues around that, but sort of segregating it and having situations where the 12 months expected losses may not be, you know, trending in the same direction as your full lifetime reserves expectations does create some issues around what the underlying expectations are, what underlying credit dynamics are. The fact that my earnings are the same in a quarter where you trued up your reserves, should I worry about that, or are you being conservative? So it does create some issues around comparability beyond, you know, just that may be new, that may make the analysis of you know, your credit trends a little bit more challenging. So I'm wondering if you guys have any thoughts on maybe some of the unexpected consequences around maybe making analysis a little bit more challenging in some levels.
Can I jump in there?
Go ahead.
Absolutely.
Because let me move this, otherwise nobody can hear me. So I have some of the same comments as Saul. I guess, you know, as I looked at this proposal, I went back to our 2013 comment letter on the 2012 proposal, and we had actually addressed it to both the FASB and the ISB. And we said to both of them, this doesn't reflect the economics of lending. One, to the ISB because it was only 12 months, and one to the FASB because it was everything. And so we said, and we expressed that this was principally what we perceived as a need, reflecting an increase in capital. But we said, hey, we'd like some additional disclosures. We had supported fair value, and we said, okay, we lost that debate, but what we really like is if you're going to book everything up front, we'd like some additional disclosures of what those actually, what those numbers actually turn out to be. I agree with Saul in the sense that I think this model creates additional judgments and estimates. I completely agree with what Dan and Brett said about, well, what does this 12 months actually represent? Because it's not just a number, the number has meaning, and we're into interpreting what that actual meaning is. I struggle a little bit too with the notion that somehow this is less procyclical. Because if what you're saying is that we're going to book everything the same as CECL, just in a different place, then your desire to lend is going to remain unchanged, because every dollar, I think what you were saying is that in fact it would change the cash flow because people would stop lending. So we really have the issue of too little too late and too much too early, right? So what's the middle ground? And investors will decide that if they have better disclosures about what in fact is the development of the losses. So I look at this proposal and I say, well, now I'd like two roll forwards. I'd like the roll forward of what you're actually going to put on the income statement, and I'd like a roll forward of what you're going to put in OCI. And admittedly, my background is insurance, so I want to know what the development of that is, right? So I want to know, what did you change at the beginning of the reserve that related to the stuff that still remains good? What did you change at the beginning of reserve that relates to what you're going to take out? And what is it that's related to impaired? Because I think you're putting more pressure on the definition of impaired as well. So to me, you're going to actually have to have two roll forwards, and you're going to have a better development of what the expectation is, and you're going to have better disclosure about what in fact happened, because explaining that is going to be more challenging. Certainly we believe that in the CECL model, we actually believe, and I think CAP Group has actually expressed a pretty good letter on what they think those disclosures would be. But our struggle is sort of, well, we know all of this. We've heard this in the 10 years that we debated this proposal. It is what it is. How do we move on to ensure that GAAP is actually meaningful to investors? And I read the letter, and it said in it that, or in one of the letters, that we'd have more non-GAAP measures, as though banks would create some different adjustment. But I sort of tried to reconcile that against what in fact the SEC was saying at the AICPA SEC conference, that they think of non-GAAP measures as adjustments to what's already in the income statement, and this would be in fact what they have labeled an individually tailored accounting principle. And I'm not sure that they're going to like that. But anyway, that I think as I read the proposal, I have, as you can tell by my comments, more questions than I think I have answers. What does the 12-month actually means? Will you do two roll forwards? What will the disclosures look like? I don't think investors, unfortunately, pay as much attention to what's in OCI. They should, but I think I just wrote a comment or an article on how one investor had commented about the new recognition of fair value of equity instruments and how their bottom line changed, when in fact their real bottom line didn't change because comprehensive income isn't changing. But I think it reflects the fact that what we've always said is, unfortunately, investors don't pay as much attention to other comprehensive income. Maybe they should. So I'm not sure putting it there helps resolve some of our questions. So a lot said there, but I think I have more questions. So I struggle with how could this get done very quickly.
Doug Wright.
I wanted to address the discussion on disclosure and rather than presentation. I think that creates, I think, particular challenges for the smaller institutions because not only are you creating additional complexity by just moving it from the presentation into the disclosures, which means we have additional disclosures that we have to put together that are going to be audited, but then we don't get the potential benefits of regulatory capital, favorable regulatory capital treatment as well. So it becomes, I think, a negative overall from an operability standpoint. I'd also like to address, I think, when we're talking about users here, I think we're in general talking about financial analysts and the larger investment community. But I think we have to remember that we also have, with the smaller community institutions, a very large user group that is not necessarily represented here. And that user group is, shareholders in community banks and so on. And some of those are relatively sophisticated, but a lot of those are not very sophisticated. And we're already talking about substantial additional disclosures to comply with CECL and explain what we're doing from a CECL perspective. So I think we need to be cautious, at least for that particular user group, about how much is going to be too much disclosure. And some would say you can never have too much disclosure, but I think it's really true for a smaller user group or a smaller institution user group, you can have too much. So I would like to caution us from, or at least have us think about that perspective. And if we provide more and more and more in terms of disclosure, some of that will get lost. And to your point, Sandy, I think I agree that people tend to pay less attention to OCI than they do to earnings. I think people pay even less attention to what's in the disclosure in many cases. And so, I wonder if a lot of that is going to get lost in the disclosure as well. Again, primarily from a smaller user perspective, but I'd certainly like to hear from Tim and Laura Beth if you feel differently.
Brad.
Thanks. Again, related to the disclosure question, Christine, that you had, I think, sure, if the information, we just wanted to make that available, disclosure would be an option. But again, I'll go back to when we think about the potential impact on the economy, particularly in a stressed environment. For banks to continue to lend, there's going to be a cost for that. And there's going to be a significant cost under CECL the way it's written today, because we've got to book all those lifetime losses up front. So we don't know what will happen, but I remember in the crisis, banks were accused of not lending. And I think under CECL, the potential for that is going to be even more significant. So if we can limit the period to which we're talking about on the income statement to 12 months and recognize those losses, again, as we've said, that gets to better recognition of the economics of what we're trying to do. So I think that's the difference between disclosure and presentation, and I think that's important. As it relates to the question on the 12 months, it seems to me that would be the most operable way to implement bifurcation approach. And technically, 12 months seems like a pretty straightforward time period. Our modelers indicate that they feel like, from the lifetime loss method, that they can take those lifetime losses and cut that 1 year period for us. Again, we've talked about difficulties on certain aspects from operability, including qualitative factors. Absolutely agree with that. That's going to take some time to work through. We're working on our qualitative approach for the entire CECL reserve estimate today. We don't have that finalized. So that would be another step. We'd have to understand how it would impact both the shorter term and the longer term. But as it relates to just trying to theoretically get to a 12-month reserve number, that to me seems pretty straightforward. I mean, even if you don't have a real significant sophisticated models, I think most companies do budgets and forecasts and look out at least 12 months to try to estimate the losses that they see coming in that period of time. So from our perspective, operability was one of the reasons why we thought 12 months was the best way to bifurcate.
Tim?
Yeah, just to hit on a couple points that I jotted down about what are we talking about when we say 12 months, just to be clear. Those are net expected gross charge-offs, actual losses that we have on the books, and net expected recoveries. So those NACO rates, those are real losses, real cash recoveries that are forecasted that come through. Those are things that I think are meaningful to investors, because then it tells you how accurate we were. You could back test that. We can show that. So I think that's important. Certainly when we look at the overall balance sheet, regardless of whether it all goes through the P&L or there's a bifurcation, you're focused on the appropriateness of the reserves and the balance sheet coverage ratios and the like. That doesn't change. This just gives more information around that, and certainly to the extent within roll forwards, as we roll forward the allowance today, being able to show within the roll forwards the components and why things change. For example, if we had our 12 months provision being flat, but coverage ratios going up, and they were all being reflected in OCI, I think one of the questions that an analyst would ask, and something we'd want to discuss in our disclosures, why is that? Why do we see near-term forecasted losses and recoveries being the same while we're projecting longer term? And maybe that's an a vision on the outer bounds of the economy, but at least you'd be able to tease that out, and to your point, probably put that through disclosure. Around OCI, I mean, we use OCI today in a bunch of standards. We use it in pension accounting. We use it in hedge accounting for cash flows. We use it for, CTA for foreign currency transactions. I mean, we use that a lot today. I think it's widely understood. We have a whole standard on other comprehensive income. And so if the statement of income is important and the statement of other comprehensive income is important, you can reconcile those two things and be able to explain those through appropriate disclosure.
Well, I think most of what I was going to say, these gentlemen covered, and I just would emphasize that, I think to Saul's point is a good one, but I would think that an investor would want to know, in particular, if your loss estimate in 12 months is going up or down and your long term is going in a different direction. I think they'd want to know that, and I think also our modelers tell us that they believe they can be much more predictable, if you will, or more accurate, maybe is another way of saying it, in the shorter time frame than they can be in the longer time frame. And the longer out you go, the more variability or volatility will be created from that modeling that may or may not ever come to exist. So, and then just echo what some of the other folks have said. That's all.
Fred Cannon.
Yeah, I mean, I would just, I think the concern for users, which I would just reiterate, is that on the one hand, more information is better, and the 12-month is more information. On the other hand, it would enter more management discretion, which means, at least from our standpoint, could reduce comparability. So it seems like there'd be a kind of a plus and a minus there that would be difficult. Just two comments. One is I don't really agree that less volatility in earnings is a goal in and of itself. I think that's just, we do certainly have, I think the analyst and investment community is, learns to live with volatility in financial statements. The second issue, though, is, and this is more of a question, is that in times of stress, as analysts, we tend not to focus on the income statement. We tend to focus on the balance sheet. And so I'm not sure, since the focus during times of stress is on the balance sheet, that this is actually going to change the thought of lending.
So maybe just to recap some of the things that we've heard, and then a question, which, sorry, go ahead.
No, I just wanted to say on the question of volatility, I don't think anybody's arguing that we're trying to eliminate volatility. I think real volatility is an important thing to see in your financial results, but volatility that is resulting from projecting several years into the future that, I don't know about the rest of you, but I have a hard time knowing what's going to happen to me next week, much less 7 years or 5 years or 3 years in the future, depending on the maturity of your loan book. Is going to be introducing volatility that may or may not ever come to pass. So we're not arguing that there shouldn't be volatility. Real volatility, of course, should be reflected in the financial statements.
So maybe just to, sorry. Go ahead, Brett.
I was just going to say, I think the clarification made around the 12 months being 12 months of charge-offs is kind of useful to understand the proposal. It does differ then from what's done under IFRS, and I think this is where some of the modeling challenges have come to play, where the goal is to measure losses that eventually emanate from deterioration or impairment in the next 12 months. So if you take a credit card loan that you expect to go delinquent in 10 months under IFRS, that credit card is going to charge off then 6 months later after delinquency under typical charge-off standards. So under this proposal, that loss under IFRS would be captured in the current reserve, hitting the income statement. Under this proposal, it wouldn't, because that charge-off is not going to hit within 12 months. So I think at least understanding that distinction is useful, but it would create modeling differences and challenges for, compared to what we do for IFRS, for example.
Dan?
I was just going to raise a similar point when I was thinking about the next, 12 months worth of charge-offs and how that would interplay with some of the portfolios looking at, credit cards and so forth. That would seem problematic to me. It would be curtailing what we're going to capture in the income statement if we use this, somewhat arbitrary bright line. Also, from our perspective, we are troubled by putting something so significant, potentially significant, in OCI. And we think that OCI, there's a need for more of a principle there. There's, the concepts behind what you use OCI for, what it represents, is it meaningful? There's a lot of questions surrounding that. And I think to the extent that, we're seriously considering adding such a significant component to OCI, there are going to be a number of folks that will ask the board to slow down and spend more time and develop, what some may ask is, a better principle surrounding OCI. So that's a consideration. And we certainly believe, from an income statement standpoint, cost of credit is an extremely important metric from a bank's perspective, and that does belong in the income statement, from our standpoint.
Thank you, Dan.
Al? Quick question to any of you, of the four of you. You've heard me talk about, splits, and I probably fall more into the camp of, I think splitting some of these provisions is actually decision useful. I think that investors would benefit, but I appreciate some of the points that Saul and Fred have made. One of the things that was really raised by investors when we originally debated. Okay. when CECL was originally debated was a split between originated loans this period and changes in prior period estimates. And I would say, regardless of where you fell in terms of supporting or not supporting CECL, investors uniformly wanted that information. I think, I don't know if it was Brad or Tim, early on in your comments said, things have changed and evolved from 5 and 6 years ago. Where do you all stand on the ability to split a provision between originations and prior period adjustments? And I think in some ways that it also addresses the comparability issues. It starts to show you more how you're aligning accounting and risk. I mean, I can see a lot of benefits, and certainly there's a lot of support from investors. So I'd like to, just see where you all stand on that ability, and you can talk about presentation versus disclosure as well.
I'll take that one. Again, as it relates to this proposal, we have had discussions with our modelers, who are very, very busy, by the way, just implementing CECL, as to how we would do a bifurcation for income statement purposes. We haven't investigated bifurcation from a standpoint of new loans versus existing book. So I can't really answer your question directly as to would we be able to do that. Going back to some questions about the 1 year period, 12-month period, I think what we would say is what we're proposing here is a framework. And, you ask about, Russ, the incurred approach. So we've talked about the reasonable and supportable period. We've talked about incurred. We've talked about 12 months. We think there's benefit to a bifurcation. We believe 12 months is the better way to go, but we're also, we also understand that other constituents might have differing views, and we think that there's merit to debating that, continue to debate it. So a lot of discussion here around 12 months. That is our proposal. We appreciate that debate, but at the end of the day, we think the framework should be considered as well.
Christine?
I just wanted to go back to the discussion on volatility and the forecasting, and a comment was made about forecasting 5 to 7 years into the future and how that can be very uncertain. And I just wondered how that time frame relates to the period of time that folks are finding are there reasonable and supportable forecast time periods. Are people forecasting 5, 7, 10 years into the future, or are you, in your experience, finding reversion to historical experience sooner than that?
Brett?
I think in our experience, we've reverted before a 5 to 7 year period. I think in some conversations we've been in, it's fairly typical to have reverted to a mean experience before a 5 to 7 year period.
So I'd be interested in, you talked about it's a framework and details to be worked out, so whether it's 1 year or incurred or some other approach, and I'm sympathetic to the concerns about the impact on performance. You can read the dissent by Larry and I, and if I misspeak, he's here, he can correct me at the break. So I am sympathetic to those concerns. One of the responses at the time were operational issues about extending the PCD model to all loans, because that model, I think, would also address performance concerns about CECL. You may or may not agree with that model. I'm unlikely to sell additional tickets to that. But interested in the operational issues that appear to come up with a 1 year split. We've talked about some, what is that year? I certainly think it's going to put enormous pressure on whether a loss is 366 days versus 365 days away. That doesn't exist in CECL because even if you were in a DCF approach, the impact on that day is going to be de minimis, but in earnings it would be huge. And so there's going to be operational issues there. There's going to be operational issues with deferred tax accounting, which inevitably come up when we start using OCI. So just in my mind, thinking about the operational issues of what I think is a simpler model on PCD, how we should think about even additional operational issues in what I would call maybe a CECL plus approach that's been proposed. In the interest of at least trying to sell tickets to that model, why did you reject it, or did you even think about extending that?
So before, I guess I just want to make sure the signers have an opportunity to kind of answer Christine's question on the reversion period. Any thoughts on that, for your reasonable and supportable periods? And are you going to forecast 5 years, 7 years out? Or would that be kind of around your historical reversion period?
I would say the conversations I've had internally at my company and then with peers, I've heard R&S periods between 1 and 3 years. I've heard very few go out beyond that period.
And I would say for us, I would agree with Tim, although I have heard of some banks planning to go out farther. But we would be more in the camp of a shorter R&S period because that's what we think we can see.
Go ahead.
I would say the same would be true for us. We're looking in the 1 to 2 year time frame.
Similar for regions as well.
Yeah, I think similar. A lot of the smaller institutions are looking probably primarily 1 to 2 years.
Mario?
Yeah, this is really to just address Jim's question. And Jim, I would buy a ticket for that bus. I feel like I need to make these comments. I think the concerns about the impact to lending, I think those are real. I know our senior management is concerned about the impact of the standard, and we are studying whether or not we will change the types of products that we offer. But a lot of that is contingent on not necessarily the accounting, it's how the accounting is treated in the regulatory capital regime. And the regulatory capital issues are real. We don't like this solution, but we are concerned about how assets are risk weighted relative to how the allowance is treated. We are concerned about how the line now is much more blurry between expected and unexpected losses. We are concerned about the impact to our bank, and I'm sure others are as well, with CECL under stress. And I think the comments about being able to predict when a recession will occur and that impact on the allowance when it does occur, because you're not going to be able to accurately predict when it occurs, all of that really ultimately comes down to capital and how that will impact the company in those times of stress. And so it's not a cash versus non-cash issue. It's a real economic issue.
Graham.
Jim, you've got at least 2 tickets sold. I wanted to, actually, to Jim's point, wanted to raise something that some of our outreach to a group that's not represented here, which is non-bank lenders. Their concern obviously is not regulatory capital. Their concern has largely been income statement presentation. And I think while we heard mixed feedback regarding the 12-month cutoff, I think they much preferred something like Jim suggested, an extension of the PCD model that resulted in a EIR that was reflective of lifetime credit losses I think, while I certainly can't speak for all non-bank lenders, the general feedback we received, this was kind of a Solomon splitting of the baby. It didn't give anybody exactly what they wanted. And so I think the operation, from their perspective, the operational costs concerns probably outweighed the income statement benefits because it didn't get them all the way to a lifetime expected EIR.
So.
I just kind of want to make one thing clear. This is more of a comment than a question, but I don't pretend to speak for the entire investment community as well. I just want to make that clear. And a lot of the issues that you guys are trying to address about comparability, volatility, procyclicality, those are legitimate concerns that equity investors, or those are concerns that equity investors do have a large portion of. So I just want to make clear that. I'm not speaking for everybody, but a lot of these issues are things that are made clear to me, quite consistently from a significant number of investors.
Dan?
Yeah, just a quick comment to follow on from what Graham was saying, and just from my perspective and somewhat lack of knowledge, but I think for financial institutions that are quite heavily regulated, we have relatively consistent charge-off policies. But when you move outside that space to kind of unregulated financial institutions, not so much. And so the variety of what you have is going to be much greater there from a comparability standpoint. So if our model is going to focus on, trying to forecast charge-offs for the next 12 months, you all might need to start to have to provide some guidance there. I know in CECL, you step back from doing that. But in order to get some level of consistency, FASB might have to start to build a model on, what's appropriate from a charge-off standpoint. Not something I'm in favor of, I'm advocating, but it's just, that'll be an additional consideration, I think.
Okay, so why don't we pause here and take a quick break? Let's come back at 10:20. That's 2 bells. So just 2 quick announcements while, nice, that's nice. 2 quick announcements. If you can all just make sure when you do speak, you're a little closer to the mic. We've gotten some complaints that people can't be heard. And the other thing, we'll have lunch for the folks around the table down the hall at 12 o'clock or 12-ish, whatever. Yeah. So if you guys want to come and join us, we'll be down the hall. That's it, and we'll just go ahead and get started. So I'll turn it back over to Shane.
Thanks, Jay. So the discussion this morning has really focused on, the fact that it's a framework, concerns around a bright line 12-month. We've heard from the users in the room about the information that they would need, meaning, what are the movements in OCI? What are the movements in the provision? Potentially some extra disclosures. I guess given everything that we've heard this morning, prior to the break, I'd just like to ask the team that proposed, the banks that proposed, how do you plan to implement the proposal or operationalize the proposal? Obviously, we've got to make a cut per the proposal at 12 months. How exactly do you plan to operationalize that? If you could give us some insights as to how you were thinking about that, that would be helpful.
Tim?
So, we're pretty deep into the construction of our CECL models as we ramp up for 1/1/20 adoption. So we're full steam ahead, and like I've heard others say, at least on the large bank side, we're getting ready to go into parallel run. And so, we are looking at those models and asking ourselves the question of, if this was passed, right, the question is, what does it look like? If it was passed, proposed and went through in 12 months, for us, most of our models are account level. And so we forecast life of loans at that level today. And so being able to go into our models would allow us to bifurcate fairly easily. I think on the recovery side, that's a bit more interesting because they're impacted by different strategies and curves, and so there could be a little bit more operational complexity, from the GACO versus the NACO net recovery side. So I think it probably depends. I mean, that would be our method to utilize account level loss modeling that we're executing today, and I think we'd be able to leverage that. I think certainly, additional disclosure proposals and the complexity of those disclosure proposals certainly could throw a wrinkle in that. I don't think we've gone down the path of looking at what that would mean from a getting ready standpoint. On the ability to identify specifically impaired loans, I think our existing processes today, given that it really doesn't, the proposal doesn't change the definition of what an impaired loan is, and our ability and utilization for bank regulatory non-accrual methods and policies for other types of homogeneous type loans exist, and so we think we could be able to identify those in the population that would be lifetime.
And for the rest of you, do you do account level impairment analysis, everyone?
Michael?
In our projections, they are at account level, but that's not to say that we can predict exact loans that are going to have a loss or not have a loss. It's more of an attempt to come up with leveraging our PD and LGD models to come up with the magnitude of losses that might be. On loans that we've already identified as criticized, we do a loan-by-loan analysis today, and we would continue to do that under the proposal to come up with expected losses on those.
So, sorry.
Yeah, I generally agree with what Mike said. We've talked to our modeling teams and believe that we can look out over a 12-month period with the loss curves and the models that we have today and get the information that we've proposed. I'll go back to what we talked about from a qualitative perspective, though, and there's work to do there. Again, we haven't built that out fully for the existing model today, so in order to bifurcate that, that's going to take some time. And then we would have to go through a process of model validation with these adjustments to our models. Our models have been through internal validation. We're in the process of kind of making adjustments to those comments that we've received, and hopefully we'll have that done in short order. But another step in the process would be this cut at 12 months.
Is that the same for you, Cindy?
Yes, it is. I would say, I'll just tag on to the qualitative. Certainly we have qualitative adjustments that we believe would be much more near term. For instance, if you were to look back over the past year, we have qualitative adjustments in there for things like natural disasters. So I think that we could easily attribute that to likely in the next 12 months, there would be certain other qualitative adjustments that we would still need to figure out how we would go back and allocate between the provision versus the AOCI component.
And so is it fair to say that you're either taking your whole CECL model, and I guess maybe I'll ask the question, for your whole CECL model, do you project out month by month, quarter by quarter? I guess how would you truncate the CECL model? Because you've said it's not two models, it's just the one CECL model that you're going to get a 12-month look from. So are you truncating it somehow, or I guess how would you do that?
Yeah, I think you could use that term. The CECL models that we built are lifetime estimates, the curves over the life of the loan products. So if you wanted to truncate or bifurcate or cut that off at a certain point, that's, I think, essentially what we're talking about. I'm not a modeler, but that's the way I understand it from my modeling team.
And I would just add to that the CECL models that we have, we're leveraging our CCAR models. So obviously those go out, they look at 9 and 13 month quarters. So it's really just taking that 9 and 13 month and pairing it back. I would also agree with Brad. I'm not a modeler, but that's how it's been described to us, that we could adjust that time horizon that we're looking at.
And then you had mentioned validation. So assuming that you did that in some way, I'm guessing that you'd have to have that 12-month piece validated and back testing and go through the governance. Am I thinking about that right? And if I am, is that an ongoing process that you'd have to establish a process for the 12-month piece and establish a process for the lifetime piece? Am I thinking about that right?
Well, I mean, I guess the way I think about it is, yes, from an initial implementation standpoint, and that we would have to have our models validated. That then becomes kind of an ongoing process in the company over time. Really, though, for financial reporting purposes beyond implementation, it would go through governance. So an allowance for credit loss committee, for instance, would be charged with, in our company, developing the CECL estimates. This would be a component of that.
Is that the same for everyone, or?
I would generally describe it pretty much the same. I would acknowledge, though, I wouldn't just say there's one CECL model. We have multiple CECL models, and certainly we have short-term models that utilize roll rate DQ inventories as some of the near-term loss expectations before they transfer over into our longer-term loss vintage forecasting. But I think the construct is generally the same, that we're able to utilize the account level loss modeling and being able to bifurcate the timing of those out.
Okay. Same. And I know you haven't looked at the Q factors yet, and you've said you'd have to think about Q factors, but do you envision, at least at a high level, the Q factors being separate processes, maybe for the 12-month and the lifetime piece, or one Q factor overlay that would then be done pro rata to 12-month and the rest of the lifetime? Like, understanding you haven't looked at it and there's details to work out, but I guess at a high level, how do you think about Q factors?
I mean, if you look at the way we apply qualitative factors today, it's meant to be picking up on losses that aren't currently picked up quantitatively in our models. And I would suggest that as we move forward, as we put more forward-looking assumptions into the models, many of the Q factors that we might have today will be picked up in the model, but there will be others that don't. And to Cindy's point, I think there will be some short-term Q factors that are identified to specific events that we don't expect to impact the losses in our portfolio beyond a specific time frame, and there'll be others that there will be less certain on, and we'll be able to more proportionately apply over the remaining expected life of the loan. So I think it just depends on the Q factor, and there's probably not a one-size-fits-all answer to that.
You guys thinking about it the same way, or?
I guess what I would say is hard to answer because of the development that needs to take place. But as you kind of step back and think about it, what you're trying to do is take a look at your quantitative results, and if there are some impacts that haven't been considered, or maybe you've got some data issues, or as Cindy said, individual events like a natural disaster. There are any number of things that you might take those model results and say, I'm not really sure this is a true reflection of management's best estimate of losses. If that's the case, I think that's what you've got to look at overall. But then if we're looking at a one-year component of that, I think you've got to make a determination within that wouldn't necessarily be mathematical. I think you'd have to think through that separately. That's my opinion.
Any Michael, Sydney, anything?
Yeah, I would say we're in the process of fleshing out our qualitative factors and starting with what we do today in the incurred model, and seeing how we can expand those out over the life of loan expected loss model. I think, whether they be specific idiosyncratic events, we take that into consideration. I think the R&S period will definitely cover 1 year, so we probably feel a little bit more comfortable with those forecasts, and maybe have, I don't want to say no need for qualitative adjustments, but probably we feel we'll be a little bit more precise, and qualitative adjustments wouldn't be as heavy in that first year as compared to outer years.
And You know, when we thought about operationalizing this and we've thought about transition, we've tried to think about how one would transition to this proposal. And we've had some discussion about how the loss emergence periods are typically greater than 12 months. And so when you think about transition, I guess, do you think about it in terms of I'd have to take my entire book now and determine which piece of that is 12 months and which piece of that is greater than 12 months and how that impacts transition? So I guess could we, if you think through it, could we end up in effect having a larger loss from a balance sheet perspective, but having a pickup in retained earnings because I've got only 12 months that is what I would actually record through the income statement, and the rest would be an OCI that would then potentially recycle back through, I guess, on a second trip. Does that make sense? Have you guys thought through that, or is that you see that as a potential problem?
Well, just one thing I would add to that, though, is that the proposal is, if you look at criticized assets or troubled assets today, it's lifetime loss. It's not 12 months. And frankly, if I'm being intellectually honest, I would expect that in the 12 months, it's those assets that will have the most losses attributable to them, as opposed to loans coming out of the performing book and going right to loss within a 1 year period.
Right, but I guess if we...
So it's more than 1 year, I guess, is what I'm saying.
No, I understand that, but I guess we think about, you know, you guys have said, well, we're gonna keep the definition of impaired, right, that we have today, and that's gonna work a lot like it has today. So if I think about the two models, I've got the incurred loss model that's got an impaired component, and then I've got your proposal that's got an impaired component. And so the impaired component is a wash, right? Both models are gonna have an impaired component. So I take those away, and I say, now my incurred piece truly is whatever my loss emergence period is, which could be 18, 24 months in some cases, and then I've got 12 months. And so I'm going to have a component of the incurred loss that's going to be more than the 12 months. And so when I think about transition, it would seem that over here, I'm going to have a big lifetime loss, of which a significant portion is going to go to OCI. And I've got to figure out of that, you know, incurred loss, how much is 12 months and less and how much is greater than 12 months and less. And it would seem like the greater than 12 months would go to OCI. Because if we didn't, I think in effect we'd create some sort of like an incurred loss floor or something. Right?
Well, I think just like the transition that we're going to go through as written, right, we're going to get the balance sheet right. And we need to know what to do with the other side of getting the balance sheet right, and whether or not we flush the entire thing through retained earnings or bifurcate it and get the OCI sort of set up for the future. You're right, the amount that would go through retained earnings is less than what would be proposed under the existing standard. It would have to be.
Okay. So I just wanted to make sure that I was thinking about that. And when we think about that transition, and then that ultimately comes to, you know, how we're going to disclose, and I think about some of the questions around disclosure about, gee, you know, users have said, I'd like to know what's going on in OCI, and I'd like to know what's going on in the provision, and presumably someone would care, although I'll open it up to users, you would care about, well, what transfers from OCI into the provision, right? Because I guess if I think about it, it could be because, well, I've grown my book, time has just gone by, loans have become impaired, so on, so on. Because you do account level, it sounds like you'd be able to provide that, although I don't want to put words in your mouth, could you provide that granularity of a disclosure that says, here are the changes that are going on in OCI, here are the changes going on in the provision, and oh, by the way, here are the things that transferred from OCI to the provision. I mean, could you provide that disclosure, and if not, I guess, why not?
I mean, I would say that while the models run account level, I don't believe that the allowance for loan losses is determined on performing portfolios at the loan level. And the PD, LGD basis behind a lot of those models is intended to take risk factors into account to come across with an estimate of what is the inherent loss that's in that total portfolio, as opposed to specifically saying, I know which loan is going to have a loss, and then to be able to say down the road that it was that loan that transferred into the provision that's going to go through the P&L, and to know how much was an allowance that was an OCI. I think that's a level of precision that, at least in our bank, doesn't exist. The individual calculations are done as a surrogate to add up and come up with the inherent losses that are within the whole portfolio.
Sandy?
Yeah, I struggle with that a little bit. Or what I mean, to me, this roll forward of OCI is incredibly complex, right? You've got, let's assume you had no impaired loans and you just took something out for 12 months. I tried to do what you were doing over the weekend. I'm not completely, I've got to do the roll forward and really understand what's in the 12 months and what's in the impaired and what the cumulative is to actually pull that off and do that roll forward. But at a high level, assume I had nothing impaired, everything went through OCI, I took out 12 months. Well, what does that represent? Okay, and look, you'd have to play through, well, okay, let's assume I never had an impaired loan and the loan matured, right? And what happens to that 12 months and what goes through that. But to me, you're going to need the beginning balance, you're going to need what you took out for the 12 months, you're going to need to know what you wrote that was new, what you wrote that was the change in the estimate on what the portfolio was that you had previously, and you're going to need to know what you moved to impaired. Because otherwise, it's just a big glob, right? And what does it communicate to you? Right? And what does the actual disclosure mean to you? Because I need to know what the amount is on those that are impaired to be able to analyze when they actually become impaired, what do I hold on them, right? As my percentage of the losses. So to me, I think when you get to the detail of that recycling, right? We have this problem with recycling on several things in OCI, right? And how do you actually parse out those pieces so that in fact you know what you took into the income statement and what it meant, and what's left in OCI and what it means? Just getting the balance sheet right is okay, but I need to know what that number represents.
Christine?
And related to the glob, if that's the technical term. Sandy's
I like it better than plug.
I understand that when the 3-bucket model was being debated, that there were concerns that were expressed about the potential for earnings management. And what we've been hearing around the table today is that there's a lot of emphasis on the net income number over comprehensive income, and that net income number is critically important. And so if we take that at face value, then that raises my concerns about earnings management, that this number that ends up on the income statement versus what's residing in the glob in OCI matters a lot. And so I'm just, I would like to hear perspectives on, as a standard setter, how I can get comfortable with the bumpers around the potential for earnings management.
Jim Croker?
So I'll put you on the spot. If you don't have a view, fine, but I saw you lost your card, so I just...
You're asking Barry Williams.
Just interested in whether you share the same perspective as Sandy with respect to understanding the flows and how important it would or wouldn't be to reconcile or roll forward the components.
Yeah, I mean, it's, I would be concerned with some of the potential outcomes in terms of what it means for earnings. And I wonder what the investment community's views would be if all of a sudden day one you have a new standard in place and earnings are higher under the new standard. And so I think there would be some element of trying to understand why that is and what the meaning of that is. On the OCI roll forward, yes, I think it is important. I don't know if just saying it's a plug is necessarily going to be all that helpful and useful. I think understanding, having some detail around what is driving the roll forward, what's migrating out of the OCI bucket into the OCI bucket, why it's changing, other than this is just a plug based because our 12-month forward model says this and our CECL model says that and everything is just in there. I think that would be something that we'd want to understand. If OCI increased meaningfully in any given quarter, what drove that? I mean, and answering, well, it's just a plug, is going to lead to more questions.
Tim, did you want to jump in?
Yeah, I guess just the term plug, I don't view this as anything remotely being proposed as a plug. I think you would have to be able to reconcile your balance sheet reserves and where the other side of that sits, and whether you ran it through the P&L or OCI, you would have to have the core records to be able to reconcile that. So I don't think it would be a plug. Understanding maybe the plug would be viewed, is it opaque? Can we not explain what's in there? I would say on the earnings piece though, the 12 months of the charge-offs and recoveries, if from an earnings management standpoint, that's always going to get trued up. We have charge-off policies that exist today. Those are specific. Those are things that we disclose in our roll forward. So as you look at what's going through the income statement portion of the provision of charge-offs and recoveries, those are known amounts. Now, on top of that, we then have builds and releases, just like we do today. Those builds and releases, acknowledging that they would be a bit more complicated because they're flowing through the third component here of OCI, but I see no reason why you couldn't be able to explain the transition. If it's just a time-based transition and you expect that charge-off that was in month 13 to 24 is now moving out, you can certainly disclose and explain that transition and why it's coming out. If it's a new view on change on the economy and the forecast of the losses, you should be able to explain those things. So I'm not sitting here saying that it is it's not complex. It is complex. There's probably a lot of complexity that we have to tease out as we think about the necessary disclosures. But when I think about plug, I don't see or feel that in the way that we would reconcile our core data and records and the underlying balance sheet reserve. And then as far as management of earnings, as we think about how we actually charge off loans or recover on those loans today, those are sort of known facts that are driven based upon policies that I don't think are subject to sort of the decision-making philosophy or other things. There's other things of builds and releases that would go into that, though. I acknowledge that.
Hal?
Excuse me, Tim, you used two words, explain and reconcile. Would you reconcile internally and explain externally, or would you reconcile internally and also show that as a roll forward externally?
My personal view is you would do detailed, robust roll forwards, just like we do of our allowance today, just like we do for OCI today. This would just be another component of that to be explained, those judgments and movements.
So you'd be disclosing the reconciliation or roll forward.
Okay. Is that the view of the rest of the group?
I probably would have leaned towards the disclosure as to the main drivers of what is causing, dollar amounts to flow in or out of AOCI and or provision. I do think a reconciliation would have to be done from the company's books and accounting records. But again, I would have leaned towards just higher level disclosure on that.
For regions and
I'd agree with Cindy.
I think so as well. When you talk about the bifurcation approach, remember, we're talking you asked a question about earnings management. We had some discussion from the analysts about disclosures, but a life of loan loss is not what we're questioning. We think the liability side of the balance sheet ought to stay intact. But by definition, then, there's going to be better disclosure. There's going to be better information if you bifurcate that into a 12-month period or some other time frame that's chosen. So that information, is not scheduled to be received today. But we think, it's more important than just that disclosure. It's more important that the income statement has components that drive and are consistent with, what's going on with our economics when we make a lending transaction. So I just think that's important. Could we do multiple cuts on disclosure? We probably could. Do we get to a point of diminishing returns? I think we do. The further out you go, I think it's probably less meaningful information. Judgments are going to change. If we had this approach, every quarter you'd be looking at making an update, so you'd be updating that real time. And, I think in addition to that, you're probably going to get some level of a reasonable back test. So 12 months after you've issued a financial statement, how much losses did you recognize? How much did you say 12 months ago you were going to recognize? I think you've got a reasonable basis to, Christine, to your point about earnings management, to have a check on that. Now, things will change. Doesn't necessarily mean if the economy changes, and you're probably going to have missed it. But I think that can be explained as well.
Cindy, just a question. When you said higher level disclosure, so I think, we were talking about a roll forward. Does that mean not a roll forward? And what did you mean by higher level disclosure?
Yeah, so from my perspective, I wasn't necessarily thinking of a roll forward presented in the financials. I was thinking more of, again, the drivers as to what would have created that change. So whether that's...
Does that mean qualitative only, or?
I think I definitely think the majority would be qualitative, but I think that there would be places where we could insert quantitative information. Haven't gone that far down the path of thinking about that from a disclosure perspective, so certainly would need to give some additional thought to what amounts we could provide on, from a quantitative perspective. But, again, it's marrying up the qualitative and how you put a quantitative amount assigned with that.
I think Tim Zimmerman was next.
I have actually two comments. Going back to what the question that Christine raised, I have a very high level of concern about the propensity for earnings management and things like that. When you have a cutoff like that, no one's kidding anybody that you're just going to run the model and you're just going to say, okay, where's it stop at, and then that's the number. There's going to be there's already a lot of judgment and estimates involved with this, and there'll be a lot of pressure to move things from month 12 to month 13 or 14 or 15. That's just the way the world works. So I'm really, really concerned about that when you have an arbitrary cutoff like that. And then the second thing is that just listening to this discussion in this part of the meeting about detailed, robust roll forwards and all that kind of stuff, remember, there's a group of us that are like, it's already pretty complex, it's already a big challenge. And when you start getting away from what are the total expected losses that you have and starting to slice them up, and then having a responsibility to tell what goes from the glob over into current and all that kind of stuff, you're creating a really large additional amount of work. And I don't know at the end of the day whether you're any better off looking at that. And again, if you're laser focused on the income statement, you're going to have pressure to make the income statement as good as it can possibly be.
Doug Wright, I don't know.
So just tagging on to what Tim said, I think the whole discussion around the detailed roll forward harkens back to the long discussions that Hal, I think, referenced earlier about, the ability to differentiate in a roll forward between prior period adjustments and loan origination and what caused the ALL. And ultimately, I think what was decided was having a detailed roll forward that identified that was tremendously complex from an operability standpoint, and primarily because once you put it in a roll forward, it basically has to be audited. And so you have to have all the supporting documentation that supports that roll forward. So again, when we talk about this reconciliation and this roll forward between OCI and earnings, and you put it in a table, or a set of tables or whatever, that puts the audit pressure on it, and then all of a sudden you're starting to produce a lot of documentation that supports why you're moving to and from earnings and OCI. And that, as Tim said, creates additional operational concerns for, I think, all institutions, but, particularly the smaller institutions who are already, kind of from a proportional standpoint, having more challenges with this. Laura?
First, I would say in regards to the question about earnings management, whether you bifurcate or not, I think the risk for earnings management is the same either way. It's just where does it get managed might change because you've added another bucket to the process. I think just simply by adding the forecast period, because of the range of forecasts that could be used, that really could be supportable. You get back to that, is it too much too fast or too little too late? And that can be controlled within that. I think that's a huge risk of CECL that we see across the board. And then when it comes to detailed roll forwards and trying to describe and explain how you get to those components, I think from a community bank perspective, I don't want to keep further complicating these disclosures and keep further complicating how we get to these answers, because my regulators are not going to understand it, my investors are not going to understand it, my board is not going to understand it. And so I think if you try to just take a step back and look at really what are we doing, we're going from where we are today with incurred losses, which includes an impaired component that we already deal with. And then it already includes right now a lot of qualitative factors, because if you look at most of the allowance levels on the balance sheet compared to what our losses have been the last few years, we're already building in what you might could estimate as 12 months worth of losses. But really, if you do a back test on that today, then I would be over reserved, right? Because if I have a 115 reserve and my losses last year were actually a net recovery, you still face those same challenges. So now you're adding in basically that third component, no matter how you do it, to move to lifetime, whether you leave it as originally issued, or if you look at now bifurcating that into a separate component. The issues are the same. We've got to get this to a manage where it's workable, it's understandable, and it's not just an exercise simply for our auditors, which is what it feels like right now. I think from a community bank perspective, things that are important are things like how do we migrate from already really strong qualitative factors into ones that make sense for now a lifetime losses. I know there's been some discussions about like a through the cycle practical expedient, which really I think to some degree we're already there. If you look at our losses in community banks, most of them are probably less than 50 basis points, but how many community banks really have a less than 50 basis points allowance? And so I think the disclosure around that and how we do that in terms of how many tables you put in there, at some point somewhere there's going to be a plug factor. I know nobody likes that word, but it is the reality. We have some of that today. I don't calculate my allowance today and determine if I need X number of dollars in provision. I don't allocate that from an operational standpoint in the way that I disclose it every year. We do look at changes. We do consider all of those factors, originations and all that. And so I'd really like to see us try to not continue to complicate this and continue to add this, but to look at how do we really get you information that makes sense, and not just for the sake of adding more and more disclosures that at the end of the day you've got so much minutia in the details that you really don't understand how our loan book has changed from period to period.
Fred Cannon.
I was just going to respond to Christine. My greater concern about the earnings management issue is the non-banks. I think at the regulated banks, I think a couple points was just that they're mostly making their lending decisions based on regulatory capital rather than what is reported as earnings. But I think in the non-banks, especially when we don't get as much regulatory disclosure and so forth, there would be a real incentive, especially during good times, to boost the current earnings, to attract capital and to create that lending and have OCI somewhat buried. So it would be much more in the non-banks where I would be concerned about that issue.
So just before we go to Michael, I would like to open up the discussion a little bit more. We've talked about some of the operational complexities and the like. I guess I'd like to hear from we've heard from the smaller institutions. I'd like to hear from the larger institutions. How, if we did this from an operational perspective, how does this change, the cost benefit equation, for you all? And then from the auditors in the room, how does this change, the audit? How do you look at it differently from an audit perspective? Do you look at it differently? But first we'll go to Mike.
Well, I just wanted to say that it's hard to disagree with a lot of what's been said. I agree with much of these comments. I think those that are bent towards earnings management, I think they're going to be doing earnings management, whether it's 12 months or whether it's life of losses. I think, frankly, in my experience, most people are just trying to get it right. And we have a lot of complex accounting rules, and I don't think most people are trying to game them. I think they're trying to get it right. I also think that accounting requirements, whether they be disclosure or not, there is an overload, and disclosure overload is not necessarily a good thing. As I look around the room, I'm probably the oldest person here, and I remember many years ago there was an AICPA audit manual on banks, but the third line in there was that verbosity is not a substitute for full disclosure. And I think rather than a detailed roll forward of debits and credits of what's going in of other comprehensive income, I'd be more interested in knowing why did it change? Why did it go up, and what were the factors that made that change? And the same in your income statement, as opposed to worrying, what subset of that number shifted from one bucket to the other. I'd be more concerned as to what's going on in the economics that have affected the changes in those numbers. So I just wanted to say I agree with the overload, and I'm not sure I think tracking individual transfers from one bucket to another is getting hung up a bit in minutia without focusing on what's the real big picture.
Christine, sorry.
Just on the qualitative description of why things changed the way they did, I think one of the concerns that I have with those types of disclosures is that we often hear from users that they become boilerplate and that all of the disclosures look identical across companies. And so I would just, if we were going to go down that path, I would wonder how we're going to ensure that those disclosures don't just become boilerplate disclosures without having some quantitative information in there as a backstop.
I'm looking over at the big banks and no 10 cards are up, so I will call on someone again. Why does Dan always go first?
I'm a
We can always
study.
count on you,
Thanks,
Dan.
Real quick study. I think clearly we'd have to go through, as a lot of folks have observed, model development for different types of loan portfolios, and then for us, that would expand, internationally as well, as there's different challenges in different marketplaces across the world. So we've got a lot of new models we'd need to develop for this 12-month period. Test, validate, validations. There's a significant amount of work that would need to be done there. And it's not clear to us really what the benefit is. How much more information is really being gained relative to this bifurcation approach. I share a lot of the concerns that Tim and Doug have raised relative to roll forward disclosures and what's involved in that, and now maybe rolling forward two buckets or I'm not sure, maybe 3 buckets of the allowance and challenges that will come out of that. Certain portfolios, when I think about credit cards today, when we're building reserves on those, we're also factoring in draws that may happen in the future. We're not doing that under CECL. Not sure how that would be handled within this 12-month window. We'd need to work through that. I do think focusing on forecasts for a reasonable and supportable time period, the way we build those up, my understanding is that that would not be too difficult to isolate what we think is going to happen in the next 12 months and beyond that time period. At least for us, that's additional work, but I don't think it's, insurmountable.
So I guess those are some initial thoughts.
Thank you, Dan. Mario?
I learned quickly too.
Good job.
So just a couple observations. I mean, this alternative, it strikes me that we're kind of moving back towards the good book, bad book approach, or some version of IFRS 9, because you still have to identify which loans are impaired or have experienced credit deteriorations and which ones don't, which in some ways you have to do that under CECL as well, but it's more pronounced and you have to separate them to account for them differently. In terms of operational complexities, I mean, I agree with Dan. When we have models, and our models, I would imagine we can identify within those models which loss content relates to the first year and what relates to everything else. But I think you still have to go in there and make sure you're comfortable with the 1 year cutoff and get it validated and everything else. So that will take time. As it relates to dealing with a roll forward, I mean, I think a roll forward can take lots of different forms. So it really just depends what that means. I think, you know, to satisfy yourselves with your loss estimates, I mean, you need to be able to do that roll forward in some shape or form. You need to be able to present that to your credit committee, to your board, to your regulators, to your auditors. So some form of that will ultimately have to make its way into the disclosure. So I would imagine something that would have to show, you know, what are the changes in the element in OCI as well as the income statement that are due to changes in economic factors, that are due to changes in timing, that are due to changes in, you know, you name it. But I would imagine that at a minimum, you have to provide quantitative information along those lines.
Mary, one follow-up. It sounded like the quantitative piece, you know, would be extra effort, but maybe, you know, less so than the qualitative piece. Has there been any thought on, with this proposal, you know, what changes you'd have to make with the qualitative factors and splitting those?
Well, I mean, admittedly, in our organization, we are at the very beginning of working through our qualitative framework. I think we've got a qualitative framework for our framework, and we're in the process of working through it. I think we intend to apply that framework today at the asset class level, as opposed to broadly at the portfolio level. But you know, then I think under this model, you have to think about going even deeper than just the class level. So that would be something else that we would have to work through.
Brett Dooley.
I think I spoke earlier about where we are and what we thought it would take to bifurcate those loss estimates into the 12-month and the longer period, including the qualitative component. I think that, you know, with respect to the roll forwards, and with respect to the split between the 12-month component and the OCI component, I think we have to look at it, and you're essentially, you may be within one overall loss framework, but you're going to have to go into this and think of them as two separate numbers that you can separately explain, that you're separately analyzing. And I think that, you know, we're often challenged with roll forwards and the precision required to do those roll forwards. And here I think we'd be talking about two completely separate roll forwards. So I worry a little bit about, I think we'll be able to make these estimates and our models work similar to the ones described earlier that are account level but I think that having confidence in the precision of those models and the precision of your qualitative overlays, differentiating what is happening in month 12 versus what's happening in month 13 is going to be very difficult. And I think it's also something that doesn't come through a lot in backtesting, because even in backtesting, the difference between what's happening in that 12th month versus, you know, a few days later or a few weeks later in the 13th month is very difficult to precisely quantify.
Mike Tubby.
Yeah, I mean, some of my background is colored by work I did here at the FASB with respect to 123R, where we took a model that hadn't been run through the P&L and created expenses for share-based compensation. I think about this arbitrary split between things that go through this expense that goes through the P&L and what goes in our OCI, and frankly, there's a level of discipline that comes when you're putting things through the income statement. It really matters, and I think that's part of the message that you're hearing. It does really matter, and I think when, you know, I mentioned before, I don't see the cost benefit. I don't see the economic principle that underlies all this and why it's distinguished from what the FASB has put forward in CECL. So if I can't see that economic variation to support it, and effectively we're going to have to do a lot of work to make the changes that my colleagues here have talked about, then it doesn't seem to be worth the pain of that. And frankly, I think the discipline that comes with putting the entire credit loss through P&L just can't be replicated.
Just a follow-up question. Brett, I know it sounded like you were saying you'd have to look at these more of two different models, perhaps, or two different processes. As adding this 12-month, assuming that you would have an additional process to go through. So you'd have your kind of CECL process and then a 12-month process. Is it fair to say, and this is for anyone, that you would need to have now a separate process for the 12-month for your internal control considerations and environment? Or would it be, I guess, just the CECL model, and then we could just carve out the 12-month and just add some additional controls, or would you look at this as a separate model and process?
I do think I still think of it as one overall process. You're going to need additional controls to deal with this time split that you're making, because that's going to matter to your financials. Do I think it's, entirely separate controls, entirely separate process? No, but it's certainly incremental.
Sandy?
Yeah, I just couldn't leave the disclosure and roll forward comment untouched. The reason that we want the roll forward isn't just because we want the mechanics of plus and minus, because using the term roll forward means many different things, right? We want breakdowns of elements so that we can actually understand the why. And so when I look at this, I say we have the good book and then we have the bad book, and we have two roll forwards of it, and we got this 12-month that sort of slides between them, right? And how does that work? I don't know how that works, but what investors are trying to understand is, how did they develop, and how did management's assessments of that development happen? And I think that's really what we're trying to ascertain. So understanding the degree to which it was an actual charge-off versus a change in estimate on the books that exist, or on the balance that existed at the beginning of the period versus a change in estimate at the balance at the end of the period are very important to analyzing the adequacy of reserve and the adequacy of management's judgment, right? Having been an auditor and having been a preparer and now dealing with investors, I think that I didn't completely appreciate how smart they are about management and these behavioral elements that are associated with these big judgments. And they want these things because they want to actually judge these things. And I don't agree that they will ever think there's disclosure overload about this item, and more isn't necessarily better. I'm just saying that this is integral. And I think that if you start moving things between the two, you're going to have to start telling people how you moved them between the two so that they can judge. They want to correlate these allowances to the assets to judge them over time. And so I just think it's the complexity of those roll forwards will not be simply by two. It will be exponential because of the fact that you're moving, just like when you do the transfers between fair values, because of the relationship between the balances. So I just couldn't. I
can let Jim jump in.
I wanted to follow up, because on one hand, I could look at the split and say you have everything today that you would get under CECL if you just looked at OCI. And there's one additional data piece, which is the expected one-year loss. And so you'd say, well, there's already more data under this approach. And I think, but I just want to test what you're saying, is in order for you to use that data, you'd have to put it in relation to lifetime. Is that effectively what you're saying? Because I could see somebody just saying, well, if you think CECL is the right approach, you certainly have that under this proposal. It's just in OCI. And so if you don't like one-year loss, you could ignore that. But you're saying, look, you gave me data, I want to understand it now?
Yeah, I'm saying you gave me data, I want to understand it. I don't know, I mean, if you look at, as I referenced CAP Group's letter before, I don't think that they believe, and I think that we share that view, that you can assess even in the roll forward that's going to happen today, or in the proposed standard, the one that 21, 22, I don't know what we're calling each one of them, that you can truly assess the development of the changes of the estimates from the beginning of the period and related to the new book. So I think what I'm saying is there's some of that we would actually like improved, but when you start to split it out, it becomes even more important, because you're trying to understand which one relates to which balance, because you now have impaired and not impaired, and then you have this 12 months. And was it related to the non-impaired, and then they became impaired? How does it, just trying to understand what it means, because when you say we can back test it because it's recoveries and cash flow, we're going to back test it by looking at the cash flow? You know, that's what I'm trying to understand, how we would in fact back test it. If it's cash flow, okay, but then we got to look at the next period's cash flow, because it's not necessarily in the roll forward, right? It really gets to what's the 12-month actually represent.
I'm going to let Doug Wright go, but I do want to hear from the auditors as well, so if you can get your 10 cards up. Go ahead, Doug.
Chip, don't drop yours on the floor. You're not getting out of it.
And actually, this will be a question really back to FASB staff and the auditors, and it's predicated on the Q&A that you just released on the WARM. And getting back to the qualitative factors, it would seem from taking a look at the analysis you did on WARM and the very simple example you provided where you calculated the historical loss rate, and then you threw basically an economic forecast factor. You ignored, for the purposes of the example, for simplicity, you ignored the other current condition factors that could go into Q&E. But it would seem to me, under that example, if you take that example and apply the bifurcation into that, that you would have to first bifurcate the historical loss into a 1 year, and then you would have to bifurcate the impact of the Q&E factors into a 1 year and a subsequent period after that. And that is the illogical assumption. So the question is, am I interpreting that correctly? And then, you know, how would you respond, and how would the auditors respond, and how would you document that bifurcation of the Q&E factors, you know, in that methodology?
Doug, I think that that's a fair question, and that's why we're asking and trying to figure out how the proposal works. Because I think that it's fair to assume you would have to make some sort of split under the proposal. How that would work right now, I can't answer that until we work through the proposal, and if that comes to fruition, then said differently, I will be able to answer that question in much greater detail a few months from now.
Kevin?
Thanks, Jay. First, we totally support the process that FASB is going through here. I agree, Shane, your process was very robust and thorough, but some valid concerns have been raised here, and I think they really need to be considered, and we fully support what you're doing. On auditability, clearly with CECL already, the level of audit effort has certainly increased. A lot more judgments are required. Forward-looking information. There's not a lot of, external data, independent data to kind of look at to help us verify some of that information. Need to use a lot more credit modeling specialists. We have the new PCAOB standard on estimates. There's a lot more things we're working on. But having said that, we will certainly be ready to audit as of 1/1/20. With respect to the proposal, I mean, splitting the debit into two amounts certainly, by definition, will increase the level of audit effort. I mean, it's too early to comment exactly to the extent of that audit effort. I mean, we're still trying to learn, and here today we learned a lot of things about the proposal, but there's still a lot of questions, about if there's any new guidance on charge-offs. We have a lot of guidance from the regulators on certain loan types, but not on everything. non-financial, non-regulated banks or non-regulated financial institutions, certainly there'll be a wide range of what might be an acceptable policy for charge-offs. Whether loss data on some sort of time continuum will be necessary. Certainly some banks can do that. Smaller institutions might have a problem with that. And that could lead to the use of more Q factors. So certainly the larger level of Q factors that's part of the overall estimate will certainly increase the level of audit effort. So it seems like we're taking a debit amount that we might not have done too much audit effort with on the income statement, and we're going to be auditing two amounts. I do agree with the comments that it's not really a plug. We won't be able to just audit, I believe, just the income statement amount without really digging into the amount that goes into OCI to understand all the elements of that. So we're kind of auditing two amounts. The disclosures, of course, you add disclosures, the audit effort is increased. But I mean, all that said, we certainly believe anything that's put forth here we'll be able to audit. It'll be up to the company and to have robust policies and procedures and put in place and controls that we'll be able to test. But certainly we will be able to audit the amounts. And again, a little too early to really say the level of audit increase in the audit effort, but clearly there will be some level of increase.
Go ahead, Russ.
So I just want to make sure I understand. I had presumed, and maybe wrong, that you would be able to audit the CECL amount on the balance sheet, audit the amount going through net income, and then the residual you wouldn't have to audit. But you're saying you have to audit all three components?
I would think we'd have to understand what's in that third component to make sure that we're not missing anything on the amount that's going to the income statement. Okay. Now, that one of those numbers will require more audit effort than the other, but it's not just a plug.
You can't just do A minus. Okay.
Right.
Thank you.
Chip.
I think we would agree with a lot of what Kevin said. I mean, we think that look, I mean, we will be ready to audit CECL, come its effective date. Clearly the alternative proposal, there would be more things for us to audit. I think, we heard a lot about there'd be additional policies, there'd be additional procedures and controls that company was set up to do the bifurcation, and we would have to audit those. Just because the number is split between P&L and OCI doesn't mean we wouldn't have to audit it. The number is still on the balance sheet. We'd still have to audit it. I think similar to what Kevin said, we'd be wanting to understand all three components of this as well, including, ensuring that we don't get stranded amounts in OCI, that amounts in OCI do kind of, in a runoff book, would run themselves through P&L.
Can you talk a little bit more about the stranded amounts component? What do you mean by that?
Well, I mean, there are other models like cash flow hedging, where we put amounts into OCI and we put them into P&L when the hedge transaction occurs. Net investment hedging is another good example of that. Impairment of available for sale securities, where we have a bifurcation of amounts between OCI and P&L. We look at management's process on calculating both amounts, as well as, ensuring that, like in the case of securities, when securities mature, that any amounts in OCI will have reversed themselves. Similarly, with cash flow hedging and net investment hedging, we audit the procedures in which companies, reclassify such amounts out of OCI into P&L. I guess another example of that would be when you do fair value option, and now you're splitting own credit component between P&L and OCI, or you're splitting the total mark between own credit component going to OCI, things going to P&L. I think we similarly looked at the procedures that companies put in place to make sure those amounts would, be gone by the time those instruments matured.
Is that done at a high level or at the individual contract, individual asset level?
Well, I mean, I think most auditing starts with understanding management's process and the controls that they have in place. So, sometimes that's at a high level or an asset level. I think it depends a lot on, what the actual management's process is.
Thanks. Graham?
Yeah, thanks, and agree with everything Chip and Kevin said, and also want to reiterate how much we appreciate FASB and the staff being willing to host this this morning and turning into afternoon. I think it just speaks to the degree of commitment FASB has to consistently seek and receive high-quality feedback and incorporate that into your process. So thank you for that. Yeah, regarding auditability, we can audit. We expect to be ready to audit CECL as it is. We expect to be able to audit the proposal if it were to be accepted. It's auditing another estimate, and I think we can do that. I do think there is significant incremental effort, potentially significant incremental effort, and some of the pressure points that I think both Kevin and Chip have hit on, but that 12-month cutoff is going to be important, and I don't think that's something that many institutions in our outreach have contemplated having to do. That would be a significant incremental effort, other than those, I guess, that are planning to use a discounted cash flow approach. We think that the definition of impairment would be, again, a point of pressure in that analysis, but also importantly, as Fred and Dan mentioned earlier, rigor around the application of charge-offs. I know we've had on our last TRG discussion, we had a big revelation that charge-offs are not really going to be an accounting thing under CECL. They don't really matter because timing doesn't matter under the current proposed model so much. But this would reintroduce that. And I think for many non-regulated entities, that is an area where there's some significant diversity. So that would be incremental. It would require effort, probably coordinating with my regulatory colleagues to make sure that whatever definition we came up works with whatever definitions they use for their call reporting purposes. And then finally, I think auditing disclosures, some of the quantitative disclosure that we've talked about today, like roll forwards. Yes, we do audit the disclosures, and that would be, I think, a meaningful effort is auditing those disclosures to the extent they were decided to be provided.
Thanks, and just a follow-up question for Graham or Chip or Kevin, but we've heard some discussion around the tension point between whether that loss is 365 or 366, so 12 or going into the 13-month period. Do you see any issue with that from an auditability standpoint or any thoughts on that?
Sure, I lead and welcome Chip and Kevin's thoughts as well. Yes, I think that's absolutely would be an area of focus. I think that cutoff would become important. And having some experience with IFRS 9, that's an area of real challenge. Particularly depending on how 12 months is defined. I think the proposal has thought it would be charge-offs in the next 12 months. So you've got two elements to think about there. One is the application of a charge-off. Just wholesale, does the entity charge off things appropriately? And then secondly, the timing of that anticipated charge-off. Do they expect it in the next 12 months or 12 months in a day? And yeah, I think there'd be pressure on that cutoff point.
I don't know, Chip or Kevin, do you guys want to add to that?
Yeah, I would agree. 365 versus 366. I don't know what level of detail a bank would have relative to be able to make that split, but it would seem like if the model is prescriptive in 12 months, it would seem like that would be something we would be interested in.
Okay. So I guess just another question for the whole group. Any thoughts on whether the proposal should be applicable to PCD accounting and AFS debt securities? I'll start with the signers first, then kind of open it up. Do you think the proposal as you've drafted should be applicable to those other two areas?
We certainly discussed, I mean, again, back to this was a framework, a broad framework, but focusing on AFS securities, we looked at how the new CECL standard interplayed with the existing guidance around impairment of AFS securities, certainly having a fair value floor embedded in the model for booking the allowance under the new CECL standard let us, at least in our smaller group discussions, that having a third bifurcation element to that didn't much make sense given all the other complex aspects of what's going through fair value. So we did not think that having a
separate bifurcation for AFS securities made sense.
The others, signers? Same, okay. Any other views? Do you think there should be separate models for AFS debt securities, or do you think one model, same thing with PCD? Mario?
I guess my initial reaction would be just like in the early days of the different models. The more the measurement models are the same, the better. So, I don't know why we would want to create a model for loans, another different model for AFS, which is different from HTM securities, which is different for PCD assets. I would think you want them all to be the same. Then I think you'd have some complexities around AFS and thinking about how you would separate things that are quote unquote impaired and not impaired. And as a result, would you have to retain some element of the existing OTTI model in order to make that differentiation? But I do think it would be important to maintain consistency across the board.
Right, you're nodding. Do you want to?
Yeah, I agree. I think, part of the project was to try to simplify and reduce the number of models, not increase. And so I don't know why we would try to do separate things for different asset classes, although I do think AFS securities, for example, would bring in additional complexities that we'd have to think through.
Anything else?
Well, Laura?
I actually just had a question for the auditors in the room. I'm hearing you say confidently that you're prepared to audit CECL going into the transition date, but I know so far we've just been told that audit cost is going to go up. Do you have an idea of the hours or percentage or what a typical audit, how that's going to change? And if you already know that, then I guess I'd be curious to see how that compares when you think about layering a third estimate for the bifurcation, because I think the auditability of CECL in general is pretty tough, and then you're adding another layer. That's one of my areas for concern, because there's parts of the bifurcation I really like, and there's parts that are don't seem as favorable, and that is one I would like to hear a little more color on.
You guys owe me a drink at the airport after this. While I don't. Not intending to help you negotiate your next audit fee, Laura Beth. I think the degree that this proposal will be incremental in cost this will not shock you. The auditor's favorite response is it depends. So, for instance, an entity that maybe is expecting to use a discounted cash flow approach, maybe this isn't all that incremental to that amount, or an entity that has relatively short-lived portfolio, maybe this isn't all that incremental, but I think to the extent that you weren't estimating timing, and now we're going to introduce that, that probably would be incremental. And I think to the extent that you have a longer lived portfolio, it's likely to be further incremental. So as far as a percentage, I'm sorry, I'm not in a position to give you that, but I think there are some factors like that you might consider when thinking about the incremental cost to your audit. I don't know, Kevin.
Yeah, I like Graham. I don't have a good feel for that. I wouldn't want to even attempt here at the table to make an estimate. I mean, I'm in the ivory tower. I'm in the national office. I don't really deal with those types of considerations, but it is obviously incremental. Sorry.
Well, and my point is just that I think the change in the audit process is significant, and so I think we don't need to make light of that in terms of adding additional things to that. I think that is something we definitely need to not lose sight of.
Any other comments from the auditors? Just looking at Chip, but I guess not. Okay. All right. So Shane, you want to go next?
Sure. So, I think from the staff's perspective, we've gotten a lot out of this conversation. We were able to take away a lot of information. And again, I would thank everybody for participating. It's been very, very helpful. I guess I would just ask, given that we are going to come back at the end of Q1 to the board, do any of the board members have anything additionally that they'd like to ask that the staff hasn't covered that would be helpful?
I don't have anything, but those of you, if you reflect on the meeting, if there's additional insight or input you want to provide members of the board or members of the FASB staff, we'd like to hear that in anticipation of the board meeting that will occur in March.
Yeah, and I think everybody here knows how to get a hold of me if they have that. Jim.
One thing that we talked about it, so we don't need to talk about it further, but I think one thing that would be useful in evaluating cost benefit would be understanding a reasonable package of disclosures. So we talked about what the components of those might be, but I think, you know, the proposal, and I think the banks acknowledged there'd be some need for additional, but what would that look like, and then how would that serve investor interest? I think fleshing that out over the time period will be important, so you all could be helpful in that process.
Any other board members? Thoughts? Nope. Okay, so I guess we can just move on to our last topic for today, which would be the vintage disclosures. So I'm going to hand it over to Chris to do the tee-up.
So at the November 2018 TRG meeting, the staff discussed an implementation issue raised by stakeholders related to the vintage table disclosure. The implementation issue relates to whether gross write-offs and recoveries must be presented by origination year in the vintage disclosure, which is shown in example 15 of the implementation guidance. At the TRG meeting, members had mixed views about requiring the disclosure of gross write-offs and recoveries by origination year. Those supporting the disclosure requirement noted that the information is critical to financial statement users' understanding of management's ability to estimate expected credit losses over time. However, many preparers on the TRG noted that the disclosure requirement would be operationally burdensome because gross write-off and recovery information is not readily available in their financial reporting systems by origination year. Those TRG members stated that their current implementation plans do not include obtaining that data and that the requirement would add additional implementation costs. Preparers noted that if the board were to amend the guidance to require gross write-offs and recoveries, additional time should be provided to implement the requirement rather than having the standard effective dates for CECL. TRG members and observers generally agreed that the disclosure would need to be clarified through a codification improvement because the disclosure guidance as written currently does not require specific disclosures of the gross write-off and gross recoveries by origination year. At its November 7th, 2018 meeting, the board decided to require the disclosure of gross write-offs and gross recoveries by origination year. However, some board members suggested that the staff perform additional outreach regarding the operational concerns by certain members of the TRG. However, at the December 19th, 2018 meeting of the board, the board announced that a roundtable would occur today to solicit additional feedback from those participants attending the roundtable in regards to whether gross recoveries and write-offs should be required. The staff has the following questions for participants today. Do preparers have the information available to discuss gross write-off and gross recoveries by vintage year? And two, do investors believe gross write-off and gross recoveries by vintage year would provide users with decision useful information? So with that, we'll turn it over to the participants.
Brett Dooley.
It's going to happen eventually, right? I guess one point of clarification, our understanding when we're talking about these gross charge-off and recovery information is that we're talking about current period charge-offs and recoveries. So, for example, if I'm showing a disclosures in 2020, I'm talking about charge-offs and recoveries that occurred in 2020 and allocating those to the different vintages, not asking the question, present all my vintages and present information about the cumulative charge-off and recovery for each of those vintages. Is that understanding correct?
It would be cumulative. I think it would be cumulative.
Okay. Because I think that some of the dialogue around operationality is very important. We had the understanding through discussions that it was current period. And just to give some context for the operational challenges, I think they differ slightly between loan systems used as well as by products. So specifically in our consumer portfolios, charge-offs are often tracked on an ongoing basis by vintage, by year of origination. And so that information is in fact in our credit systems and could be obtained. The recovery information is more challenging because a lot of times that recovery information is not fed back into the original loan system that has all of the vintage data. So if you think of a period where you have a recovery through a loan sale, you sell a group of charged off loans, you get a gross recovery from that. The question is, how do I take that dollar value of the gross recovery? And first of all, I have to decide to take that from my general ledger back into the loan system. And then I also have to judgmentally figure out, how do I take that dollar value recovery and say X of it related to this loan, which was in vintage A versus vintage B. Is that possible to do? I think it is. First of all, you have to make some judgments around allocating. And then secondly, that process to go from the GL back to these originally loan systems largely is a manual process in the short term. I think it obviously gets complicated if you're dealing with one GL, one loan system. That's one bridge to go through, to go over. Many firms operate with multiple loan systems, and so that manual process isn't even as neat as I described, because you're pushing back into multiple loan systems that generate these things. All of which tells me, from an operational perspective, I think we would be challenged to do that in the time frame originally discussed. It hasn't been part of our implementation plan. Generally, when we go through disclosure changes like this, we try to do several rounds of dry runs, generally off cycle. And so we're already dry running these disclosures and working through that in 2019. And so this would be a significant add-on for the interim. If you're to tell me incrementally that this is a cumulative disclosure, now you're talking about if you're really making it cumulative, going back to all of the data I'm presenting for all vintages and going back and figuring out recoveries that happened 5, 6, 7, 8 years ago or more to deal with vintages of loans and loans that are no longer books that were charged off several years ago. I think to do a cumulative disclosure in transition seems like a very, very significant amount of work.
And I just echo those very same comments. And I just add in that, that's not the way the books are actually managed internally for risk management purposes. So, by vintage, it's by credit quality characteristics. So it'd be tons of work.
So if we think about this in this cumulative versus current period, I guess there's two questions. One is current period more doable, more operationally feasible, and then to the users of the group, is that something that you could live with as current period as opposed to cumulative? What are your thoughts on the difference between the two?
Fred Cannon.
Well, as the members of the TRG know, I'm a big advocate for this disclosure, so I'm not going to back away in any way for that, Mario, so I won't say that. Worst case, I think if the board does decide, which I would not encourage, but I would, because we want the disclosures, I think it's the one way to make all this make sense so that we can analyze it and get the best possible forecast of, future reserves and expenses. I think the point here is you'd still create cumulative over time, correct? So it would, we wouldn't get cumulative the first quarter of 2020, but by 2025, we'd all be good. Depending on the portfolio.
Probably a longer period, because if you have some loans on the books that may last 10 years, like they're going to be in those vintage disclosures for much longer period of time. But I think your concept is right, that if you start to do current period, that information would build up and accumulate over time. I just don't know that it's all going to be there. It's not like going to be in 5 years, you're going to have all your cumulative data.
And could you then live with a time frame that wouldn't be, we would start with that data on that first quarter and have essentially a catch-up for the longer duration portfolios over 2 or 3 years. Is that doable? I mean, that certainly should be more doable than.
You're giving more time to go back and do that reconciliation in that manual process. So more doable, yes, but still a chunk of work.
Hal?
Fred, worst case scenario, you don't get cumulative, you only get current period. What would you do? You'd be getting the current period each quarter. What would you do with that information?
I mean, because you don't have the loss curve, the historic loss curve, you just start to create it. That's all. You start to create the cumulative piece over time, so you can better understand it.
Create your own cumulative over time.
Right. But again, you wouldn't. The first quarter of 2020, it's not going to be terribly useful.
Gotcha.
But it will be useful as you build the database over time.
Okay.
Sandy?
Yeah, I was going to say, I wasn't sure when Fred was talking, whether he was talking the cumulative on the loss or on the recovery. So are you talking about knowing it for the recovery as well? Because I only draw the analogy to insurance because what you're really talking about is paying versus selling.
The challenge with the banks, at least as an analyst, is that if you just have net rather than gross, and then it's very hard to figure out how the vintage is performing. I mean, if, again, everybody knows where I come from on why perfect, what I would like. I think so you're saying, okay.
Oh, I'm sorry.
We'll require that they give us gross on a historic cumulative basis, but we'll only get recoveries on a go-forward basis. Is that what you're suggesting?
Or
would that be better than?
Or there's some way to give a cumulative recovery, but it's not on vintage year, and then you allocate it in some way, because over time in an insurance company, you do paid, which is current year, you do incurred, which is cumulative, or K plus change in or the outstanding plus the paid, and then you do salvage and subro. But a lot of people don't do salvage and subro because they have the same issues, from what I remember. That's done more on a more aggregated level, right? So then you know what the worst case scenario is, and then you can allocate your salvage or your recoveries in this case in a different way. I mean, I would be in the same camp as you are, but that would take time over, for the perfect solution. But in an interim step, is that something that?
Well, again, I wouldn't ever back away from the vintages on vintage charge-offs, because if we don't have the vintages, it's going to be almost.
No, I'm not saying back away from vintages on charge-offs. I'm saying backing away from vintages on recoveries.
Yeah, perhaps what the discussions evolved, since both Sandy and Fred say that the ideal would be cumulative gross on charge-off and recoveries. Perhaps the real question to the preparers is, if that's the goal, what is the most cost-effective way to get to that goal? Is it to wait 4 years and have a blunt and have you go and look back, or is it to accumulate over time, or is it to do some kind of hybrid discussion? That's really the question. If that's the goal, what's the most cost-effective way to achieve that goal? Or if you disagree with that goal, please discuss that.
Dan?
Yeah, I would say if we have to go cumulative, it's really building it over time on a prospective basis, and would prefer not to have to go back and do a detailed analysis on write-offs and recoveries that happened in 19, 18, 17 to build up the table cumulatively. And so over time, it might be a 5-year transition depending on how many vintages you have there. It will take a few years to build up that information on a go-forward type basis. But it is going to get to be much more difficult to go back 5 years. And I agree completely with all the comments that Brett was making relative to the challenges and the considerations and the different types of portfolios, and in the retail space, more focus on charge-offs, you know, and what's in the risk systems that attach to vintage versus financial systems. A lot of challenges. So it will be a manual effort for a while till we can build out, you know, a systemic approach. But also observe, not to put, you know, too much focus on the words, but the illustrative example, I think, in the standard does say current period. So I kind of read that to mean current, but I appreciate, you know, the desire for cumulative.
Mario?
Again, I agree with all the comments that have been made by my colleagues here. I guess I would start with, this gets to the question of what's the right balance between what users want and preparers should provide. We have users that would really desire this information, but you're hearing from us that we don't actually use the information to manage credit risk. So why is that information that we should have to provide? So there should be sort of a discussion there. If we're not using it, why are we providing it, and what are they doing with it, and why is it relevant? Secondly, I think, you know, I don't think I'm exaggerating when I say that we have dozens of loan systems. So the complexity here and the timeline to be able to produce this information is long. And so we would, if we had to produce this, we would support current period and we would support prospective. And while this information might be captured in the loan systems, you can't produce a report that says, give me a vintage report of the charge-offs and the recoveries for each of my loan portfolios. So there's a lot of work that will need to be done in each system to be able to produce this information.
Shanda, you want to jump in?
Yeah, you just answered a question that I had, which was, is this really just an issue with recoveries, or is it also an issue with charge-offs? It seems like Brett was indicating for charge-offs it was doable, but...
It's both, but more so recoveries are more difficult. But even just to get the charge-off data and run a vintage report will take some time and effort.
Then I wanted to just take a moment just to remind everyone why investors told us they need this information, and that's because what I was saying before about the CECL reserve is that it encompasses a lot of things. You know, it encompasses the origination volumes, it would change due to mix changes, it changes due to credit deterioration or improvement. And so understanding why it's changing, and, you know, being able to really understand, is it a volume thing or is it actual credit changes, is really important. And investors felt that going back and being able to, you know, look at each year and how the losses are developed and how they've actually come out over time, that's really what they're trying to get at. And without that, it becomes very difficult to, you know, really understand what CECL's telling them.
So may I respond?
Sure.
So I don't disagree with the premise. I mean, I think if the information was important, then management would be using it, right? Because as I said earlier, and I agreed with the discussion on the roll forward, that there should be information that is provided to show why things are changing when they're changing. But there should be some level of consistency, I think, between what we use to manage our credit risk and what users are receiving to understand how we manage our credit risk. And so we're going to create a process now where we have to identify all new data that we don't use to manage our risk. Then you sort of have the tail wagging the dog, which is now we're creating a whole new process to produce information that we have to create controls around, that we have to manage, just so that we can provide it to a user group, and we're not using it to manage our credit risk.
Jim's had his card up for a little bit.
I just wanted to follow up, Brett, on your observation that recoveries are often monetized on different basis if they're sold as a group, and you kind of pair that with Sandy's suggestion. One approach would be to handle recoveries differently, and then investors presumably would, if they wanted to put into vintage years, would have to do some allocation. Another would be, if we were to require it, for us to provide some guidance saying, you know, in the absence of the ability to track individually, what allocation approach you might use. For example, just straight line across or weighted dollar. Any thought of whether you'd rather have us provide some flexibility or just let investors spread? Seemingly management could probably do a little better job of putting those in buckets than maybe but just because you have the data.
Yeah, my sense.
Appreciating that it may be difficult to get.
Yeah, I mean, my sense would probably be not to be proscriptive, because in the absence of something proscriptive, you couldn't do anything else. You may default to a straight line, but to your point, in some cases, you know that's not right. You could do something better. And there are a number of recoveries, obviously, that do come directly from the borrower through, continued payments. And so I think that the notion that treat all recoveries separately and just show gross charge-offs seems to be a little inadequate too, because you're going to be producing charge-off information where there's relevant recoveries that aren't being captured, on a similar basis.
I'm going to let Laura go. Go ahead.
Forget every time. I would just say from a data standpoint, for sure, cumulative charge-offs and recoveries would be very difficult, and that is not different from the data issues that we already have, even just to convert over to life of loan. I think it is certain that if you could do going forward, if you need to track those in that manner. I think there are still some issues though in terms of tracking loans. I will say our core systems are behind in terms of being able to track a loan to its true terminal status, especially in cases like a TDR. So if you need to rebook a payment structure, you want to see what that looks like, or you basically have to pay that loan off or close that loan out and then move it in order to accommodate the payment structures that are needed. And so there's still some real data issues that we're overcoming, and this would just exacerbate those if we were to have to do that on a cumulative basis early on. I also question the usefulness of it. I think, again, it's a component where you think about how the usefulness would come into play. It really depends on the type of portfolio. So if you're looking at 5 years and then anything that was originated prior to that, well, if you have a student loan book, then probably everything's going to be in that vintage. So is it really, is that really even necessary? And so I think we have to be careful and to not. I liked the points across the table in terms of, are we really just creating something that in one pocket for one particular bank, one particular portfolio, it makes great sense and is very useful to investors, but then you're applying it across the board for all banks or all companies and all portfolios that maybe in totality is not as useful as it seems on the front end.
Doug, then Hal.
My only additional point is, assuming, I guess, moving forward on a go-forward basis only, I think in addition to suggesting if we're going to do this, we do it on a go-forward, I think we'll need more transition time than what's been allotted. I think there's got to be a slower transition because, for all of the loan systems, this represents on the recovery side, I think, a pretty significant change in how the systems are constructed. And so that means we have to get, most of us, particularly smaller banks and smaller credit unions, rely on an outside provider to do our core systems. So that means getting the core systems to change and putting it in, their priority scheme and so on. So that's a time-consuming effort, and it won't happen, certainly within this calendar year for those people who are required to be up and running next year. It's questionable whether it can happen in 2 or 3 years because it's such a kind of big change and foundational change to how particularly recoveries are handled by the core system. So I think there needs to be some thought about additional transition time if we go forward with this as well.
Tim, why don't you go ahead and then Hal?
I agree with what my colleagues here say, but I also completely agree with Mario where this should be a separate discussion. I mean, if it's information that we don't even use, I mean, there's like, where does it end? Where does the need for information end? And, obviously, if you could do it, sit in the room when we're making the underwriting decision, see if you agree or not. I mean, that's the complete ridiculous example, but there has to be a limit on what you need to be able to analyze this, and for what we would have, the effort needed to go through and provide this would be gargantuan. And then you just wonder, since we don't use it, how valuable is it? I understand you want more information, but there's got to be a limit to this at some point.
Thanks, Tim, because I'm going to push back a little bit on this, because when we were out talking to investors, they're under the impression you've got a lot more information on vintages and analysis than what I'm hearing. But I wonder if it was Laura that really hit it. Some portfolios, this would make sense. other portfolios less so. I think you use student loan, or someone used student loan as an
Right.
example of that. And I know we talked about that at the board table about this specific issue because of the 5-year time period. So, Mario, my question to you is it never used, or is it not used for certain products? Because there's certainly an impression out there, particularly in mortgage portfolios, which you all are fairly big in. It's
We don't manage our credit risk on vintage. I agree with the comments that Bank of America made, which is we manage them based on their credit quality.
so if an investor came and said, how is vintage 16 versus 17 or 18, they would.
I'm sure we could produce something, but it's not actively used in the development of our allowance or credit risk management.
That's helpful. Thanks.
Christine?
I just feel the need to leap to the defense of users a little bit. So I understand the point that managers may not be using this information to manage their business, but I do think that we need to recognize that users are doing different analyses for different decisions. They're not trying to manage your bank. They're trying to decide whether or not to invest in your bank. And so that may lead to a different set of information that they need. The other point that I'd like to make is that perhaps if users could see all the information that you see internally, they wouldn't be asking for this information, but they don't. They get a very, minor subset of the information that you're using. And I'm sure that information differs from bank to bank. And so when we're writing standards, of course, we have to write something that's consistent for everybody. So in the absence of seeing the full information set that you get to see, I think what you sometimes hear from users is that they're asking for something that they think could be provided that would be consistent across different institutions, that would provide them some insight into what you're seeing, but maybe in a different way.
Brent Cannon.
Yeah, well, thanks, Christine. I think she basically said what I was going to say, is that we don't have all the information the banks do. I hope they use all the information they have to do the very best they can. I would just say that vintage analysis historically proved to be, I think I can validate that, some of the best analysis that we use to be able to forecast future losses. And it was not just one or two asset classes. It was, it was construction loans. It was most all the mortgage credits. It's most all the consumer products. So it has proved historically from an outside user of aggregate information to be critical.
Sandy?
Yeah, I was just going to echo what Christine said and Fred said. I think the challenge is that while investors hear you do it by credit quality, they don't see necessarily the disclosures in the same way, where you're adding on new business every year. So there, and moving this to the 12-month creates another time element of this disclosure, and they want to see how these things progress over time. And so that the challenge when they hear that the information's not available is that they say, well, then how are you managing this stuff, and how do you know it turned out okay? Particularly under a new CECL model where it's a large amount is being added every year. So the question that comes up in the mind of an investor when you say it's not available is, well, then how are you managing this? So I think that investors want it because they want to see how the development, but they also want to understand how you're managing it over time.
Tim Zimmerman?
Just to quickly respond to that, I think the quick analogy is because we're looking forward and we're looking at the elements of the particular loan we're making now. We're not looking in the rearview mirror. Hopefully we've learned, because we know if we had charge-offs, we know if we made mistakes, and hopefully we've corrected that going forward. But we're looking forward and we're not looking backwards. So we're not accumulating this data to be able to say, okay, we're looking at this loan today. Should we make this loan based on factors that were impacted to a loan we made 5 years ago?
I agree with that, but they say past performance is not indicative of future results except in human behavior, right? And management and these estimates are human behavior. And so I'm not saying I disagree with you. I'm just saying that that's what investors, they want to see how your estimate turned out, and that's why when management changes, it's an important consideration.
Thank you.
I should have a quick response to that. I think it's true that when you look at it, we're trying to put it into vintages, but it's true that what we're looking at are other credit quality factors. The best example I can give of that is construction loans. We know construction loans were hard hit during the last recession. We look back at those and not say, well, most of our charge-offs were the loans that were originated in 2007 versus the ones that were originated in 2006. What we looked at is where did we start to see the inflection points? Where we started to see that was on when our borrowers went from making a 30% profit down to a 15 and 10% profit. It had nothing to do really so much with the year in terms of how do we plan for that going forward and how do we look forward to that. And then also, I think materiality and trends come into play as well. So, for example, we had some significant recoveries this past year. Those are relevant to our total allowance, and it's relevant to what our impact for our income statement was this year. But is it really affecting my credit decisions going forward? No. But are we looking for similar trends in the Nashville market? Everybody knows Nashville's hot. There's lots of growth there. When we will start to make differences in our decisions is when we start to see similar trends. So when we start seeing profit margins go down on projects and we start seeing that at a trend, that's where we will make strategic decisions, not so much about, well, we made too many, our percentage or our dollar amounts were too high in this vintage and that looks a lot like the past. So I see where you're going and why, but I don't know that disclosure provided is going to get you there.
Are there any other comments on issue 2? I will take silence as we are done. All right. Again, speaking for the staff and the board, actually, thank you so much for coming today and sharing your thoughts on this. This has been hugely important. It's important to the process, and we will be presenting this toward the end of Q1 to the board, everything we've gotten here, plus all of our outreach that we've done, that we're going to do, and our independent analysis. So thanks, everyone. We're adjourned.